Hi all, a very warm welcome. This is CA Vaidehi, and I'm here to give you a rapid revision of all of the chapters which has your standards on auditing for CA Intermediate. So the first chapter which we'll be covering is being presented in the screen. It is your chapter 1, which is nature, objective and scope of audit. So in your exams, the weightage of chapter number 1 is close to around 4 to 5 marks. So in your CA exams, any questions you take, it will be either 4 marks or 5 marks, which I'm talking about descriptive, right? So you will have 1A, 1B, 1C, 2A, 2B, 2C, and going on further. And in sixth question alone, you'll have 2A, 2B, 2C, 2D. So out of C and D, you'll have to choose one. So any question you take, you'll have to it'll be for around 4 marks or 5 marks, so you will have to work through and try to bring it as a 4 pointer or 5 pointer answers. So don't write in paragraphs, try to bring it in points. Your presentation matters a lot. All these general tips is really going to help you with respect to audit. As such is not really a difficult paper. Trust me, it's a very practical subject. Once you all finish your intermediate and start doing your articleship, you'll kind of understand what I'm telling. And through this revision, I'm here to just give you a practical flavor of what we do in an audit. Right? Okay. So quickly moving on to chapter number 1, nature, objective and scope of audit. So as part of this chapter, you have general advantages, disadvantages, scope of audit, what is audit, why do we have audit, and are there any standards which we need to follow with respect to auditing? And other than that, are there any other services which we can provide as a professional? Right? So this is the bird's eye view of chapter number 1. Again, the weightage is around 4 to 5 marks. Quickly, you can finish off once you're done with your costing exams. So the definition of audit. Over here, they tell that it is nothing but an independent examination of financial statements, which can be of a profit-oriented entity or a non-profit-oriented entity with a view of expressing an opinion thereon. So to make it, very simple, let's say audit is nothing but a teacher correcting an answer sheet. That is what you do in an audit. So your answer sheet is nothing but equal to the financial statements. Who prepares the answer sheet? It's the student. Right? Over here, the financial statements is being prepared by the management. And the teacher corrects your answer sheet. Over here, we're going to call it as examination, and that is going to be done by a person called as audit. So let's say you all are writing your exams and there is a concept of self-correction. And do you think ICI will let us do something called a self-correction? Right? That's absolutely impossible because they don't trust us. Right? Similarly, for financial statements also, they ask an external person called as auditor to come and check and verify. That is why they call it as independent examination of financial statements. And even in school, your teachers are no way related to you, right? They are also an independent person. Only if an independent or an external person comes and corrects it, only then the evaluation is considered to be right. So that is why in the definition itself, if you see, they've used the term independent examination. So what they're trying to tell over here is the auditor and the entity or a company must not have any relationship. So there must not be any relationship between these two people. That is what they mean by independent examination. By examination, what do they mean? So you take one account at a time and you see, okay, in financial statements, there is an amount. Is it really that much? So for that, you get some evidence, you perform some procedures. So that is what is called as independent examination, right? And that financial statements can be of a profit-oriented entity or a non-profit oriented entity. And the end result of an audit is going to be audit opinion. So if a paper is being corrected, the end result is going to be your marks that is equivalent to your audit opinion with respect to audit. And where will the marks be presented or the results be presented? It will be there in your mark sheet, right, which has the marks. Similarly, over here, it is going to be your audit report, which will present the audit opinion, right? Okay. So audit, as I told you, is an independent examination of financial statements, and the end result is going to be audit opinion in a written report called as audit report. The origin of audit, it is actually derived from a Latin word called as audire, which means to hear. So this part of, origin of audit can be asked as an MCQ question. Right. Next, moving on to the concept of why we have something called as an audit. So you need to understand that there are a lot of users who take decisions based on this financial statements. So they use the inputs given in the financial statements to take a lot of decisions. For example, investors or customers or creditors, a lot of people, and banks, especially banks, and also the government. All of these stakeholders take decisions purely based on the numbers which is available in the financial statements. So management is doing the business, and management is presenting the performance of it through the financial statements. And let's say we all are investors and we'll have to take decisions. I cannot believe on the numbers presented by the management, right? So I, as a shareholder, will want to know whether the numbers or the profits or the assets being presented by the management is right. And humans make mistakes, right? So I need to take an informed decision with your financial statements. So I don't trust the financial statements that easily, because business is done by management. They prepare the financial statements because they're doing the business. They want to show that the performance of the business is really good, whether it is good or not, right? So for that, the members usually appoint an external person called as auditors. So because of a little bit of trust issues, maybe that is why they brought in a subject called as auditing into the picture. So a lot of stakeholders, meaning the users, take decisions based on financial statements. So to increase their confidence, or to put it in ISM, whatever is given in the book, they've used the term to enhance the confidence of these stakeholders or users. They have brought in the concept of auditing. So this is the main purpose of audit. This enhances their confidence. So when someone comes and tells us that, okay, this financial statement is audited, it is, corrected and checked by an external person, you will have a lot of trust on them and say that, okay, fine, it's checked by someone, so I can take the decision now. I don't need to worry, right? So that is the main purpose of audit, or reason as to why we have audit. Now moving on to audit being interdisciplinary in nature. So this is very simple, guys. You all, whoever are watching the class, you all are going to become the auditors. So you all are the future auditors. And as part of your exams, you're not just studying audit, right? Audit is just one of the subjects. You have accounting, you have law, you have financial management, you have so many other subjects, right? Why are you studying? Because audit is interdisciplinary in nature. Because if you're going to audit a financial statement involves, inputs from various other subjects. For example, the main thing is accounting, and there will be a little bit of financial management, right? Because there might be some derivatives or shares or valuation, and then they might be following companies act or LLP or partnership or anything. So in that case, a lot of this, including maths and law, are involved as part of audit. So audit cannot, or an audit is not a sole disciplinary subject. It is dependent on other subjects as well. It cannot stand independently. For you to perform an audit, you need to know other subjects as well. So quickly, let's discuss what are the overall objectives of an auditor. So this is given as per SA 200. So the name of the standard SA 200 is Overall Objectives of an Independent Auditor and the conduct of an audit in accordance with standards on auditing. So actually, to put it in very simple words, there are only two different objectives. One is, you as an auditor, you need to give an audit opinion, and the audit opinion needs to be in a written report called as audit report. So these are the two main objectives, but in the standard SA 200, they have elaborated a little bit. So the first one, to obtain reasonable assurance. Again, with respect to assurance, there are two types of assurance. One is reasonable assurance, and the other one is absolute assurance. Absolute assurance in general, it means nothing but giving guarantee, right? Can you give 100% guarantee with respect to anything? No, that is completely impossible. See, imagine that you're a doctor and someone comes and begs you that and asks you to promise that yes, you're going to definitely save their life. And let's say the mother or the father of, the patient is coming and asking you to promise, please promise that you'll save my son's life or my mother's life. Can you even do that? No, right? You can never give 100% guarantee. So that is what is called as absolute assurance. But in audit, we give something called as reasonable assurance, which is the highest form of assurance which an auditor can provide. Slowly, we'll discuss why we cannot give absolute assurance and why we're going to give only reasonable assurance, right? Okay, first, what are they telling? First objective, you have to obtain a reasonable assurance about what? That the financial statements as a whole are free from material misstatements. So, when I say misstatements, it means nothing but mistakes in the financial statements. And they use a threshold to classify the misstatements as material and immaterial. So, let's say you identify a mistake, which is called as misstatement, let's say of 1 rupee. Do you think people will be bothered about 1 rupee, or let's say zero point 0.5 or zero point 0.6? All these are rounding off items, right? So auditors as such, they use a threshold because they cannot see everything, they cannot evaluate everything, they cannot check everything. Imagine, let's say you're auditing a company as big as Reliance or ITC or Adani. It is impossible for you to look through all of the transactions. So auditors use something called as a threshold to prioritize certain things, right? Even in our exams, our preparation, we are going to prioritize only the chapters which are of high weightage marks, right? So for that, let's say we are using a threshold of 5 marks. Anything which is going to be asked for 5 marks or more, I'm going to sit and prepare. So that 5 marks is called as a threshold. Over here, it's going to be called as materiality. So you have obtained certain reasonable level of assurance about what? That the financial statements as a whole are actually free from material misstatements. And these misstatements can be intentional or unintentional. So that is what they say. If it is unintentional, they say that it is due to error. If it is intentional, they say that it is due to fraud. So you yourself, they always say self-confidence is very important, right? Even for your exam, self-confidence is really important. Till date, you have finished off your G1 exams and you're into G2, you're in the second last paper, you just have two more papers left, you've prepared and watched classes all along. Self-confidence is what is going to take you to a lot of places. So, or in audit as well, first you need to give yourself the assurance that yes, okay, fine, the financial statements does not comprise of material misstatements which can be due to fraud or error. Once you yourself get that assurance, then only you're going to express an audit opinion. So that is the first objective. The second objective is to report on the financial statements, which talks about nothing but the audit report. So two objectives: you obtaining reasonable assurance that the financial statements as a whole are free from material misstatements which can be due to fraud or error. And the second one is to report on the financial statements. Now moving on to the next part, which talks about scope of audit. Scope as in boundary. What and all is included or forming part of audit and what and all falls outside the scope of audit. So usually as part of, whatever I'm going to take, we're going to form a catchword, right? A small acronym through which you're going to remember different points. So the acronym or the catchword for scope of audit is actually ARD hyphen PAIC. You can rephrase it however you want. So ARD are the points which covers as part of scope of audit, and PAIC, you can also call it as, RAD, PICA or DRAPICA, however you want, right? So this ARD forms as part of your scope of audit and PAIC is outside your boundary of audit. So as part of audit, what are your responsibilities and what and all is outside your boundary or outside your responsibilities is what is discussed as part of scope of audit. So here you can expect theory questions. They will test you as to what and all is forming as part of your responsibilities and what and all is outside your responsibilities. Right? Okay, fine. Now ART. A stands for coverage of all aspects of the financial statements. It means that if you're taking financial statements, it starts with your P&L, then goes on to balance sheet, then your statement of cash flow, statement of changes in equity, and notes to accounts. All these five are there. So you as an auditor, can you just say that, okay, I'm just going to audit balance sheet. I'm not going to see anything else. Or no, I'm bothered only about the profit. So I'm going to just, go through the P&L account. No, it is your responsibility to cover all the aspects of the financial statement. So that is what A stands for. Then R, which talks about reliability and sufficiency of financial information. So financial information is nothing but the information used to prepare your financial statements, which is your trial balance. Based on that information only, you would have prepared the financial statement. So you have to understand how reliable it is and whether it is sufficient or not for preparation of financial statements. So that stands for R. D stands for proper disclosure of financial statements, financial information, right? So another important point over here, it is the management's responsibility for preparation of financial statements. It is not the auditor's responsibility for preparation of financial statements. Over here, what are they telling as part of D? Proper disclosure of financial information. Over here, what they're telling is management might not be well equipped with all of your latest amendments or auditing standards or accounting standards, etc., etc. So sometimes here and there they might miss out things. So it's the auditor's responsibility to ensure proper disclosure. So even if they miss out, even if they don't know, it is your responsibility to tell them and point out them, boss, see, you have missed this. So it is your responsibility to disclose it properly. So that is on ARD, the 3 points which covers as part of your scope of audit: coverage of all aspects, reliability and sufficiency, proper disclosure of financial information. Now, what and all falls outside your scope of audit, which does not fall within your responsibilities? It is PAIC. P stands for preparation and presentation of financial statements. So as I told you, it's the management's responsibility and not the auditor's responsibility. Even if the management comes and requests and asks you to prepare financial statements, you can straight ahead say that, no, it is not forming part of my scope of audit. You can just help them with some things and tell them that this is how you're supposed to do, but you are not supposed to be the ones who are going to prepare the financial statements. A stands for authentication of documents, or evaluating the authenticity of the documents. When I say authenticity, it means the originality of documents. Let's say they give you an invoice for verification, or they give you all of the cash balance for performing something called as cash count. Cash count means you just have to count how much cash balance they have. Is it your duty or responsibility to see that cash note and identify whether it is, true currency or fake currency? Is it your duty to evaluate the originality of the currency or the invoice? No, it's not your responsibility. Your job is to just believe or trust that whatever the management has given is to be of true in nature and not that fake. See, basic checks, basic questions you are supposed to ask, but you cannot go beyond a point of line, right, with respect to audit. So it is not your duty to evaluate the originality of the documents. That is actually done only as part of investigation. We don't have the powers as an auditor, which is our next point, I. It is not in the nature of investigation. There is only so much which you can do. You don't have the rights, duties, or powers which you have as part of investigation. Then C. C stands for duties outside the competence of the auditor, or duties outside the scope of competence of the auditor. So C stands for competence. Let's say certain things I might not be capable of understanding or doing. Let's say there is a lot of calculation involved for which I need a help of a mathematician, or let's say there is a case going on for that I need to calculate the provision, but I don't know what's the case outcome was going to be, right? In that case, I need to use the help of a lawyer, or management would have used a lawyer, and I don't have the expertise to understand certain things. So audit is being very humble and sweet and telling you that, boss, it's okay, you're a human being, you are not expected to know a lot, so you can use the help of an expert to evaluate and perform certain audit procedures and get certain audit evidence. So this is outside your scope of competence or knowledge. So in that case, you can use the help of an expert, right? So that is on scope of audit. Now moving on to the limitations which you face as an auditor. What are the different limitations? So here they are calling it as inherent limitations faced by the auditor. Inherent limitations or restrictions, all these are the issues faced by an auditor. Because of auditor facing such issues, this is why an auditor actually provides a reasonable assurance and not absolute assurance. So in exam, they ask you what type of assurance an auditor provides and why. Your answer should be auditor provides reasonable assurance. Why? Because they face certain restrictions or limitations as part of their audit. So the catchword or the short form or the acronym for that is NNIFT, or let us in short call it as NIFT. So first N stands for nature of financial reporting. So as part of the financial reporting process, so when I say financial reporting, it means nothing but the process of preparation of financial statements, which is the management's responsibility, right? When they prepare the financial statements as part of their process, there are a lot of judgments which will be taken by the management. So in that scenario, you cannot question all of their judgments. They say, like, sometimes, you say that you have a gut feeling, so that is why you took the estimate or whatever it is to be of this amount. In that scenario, you won't have any proper basis or evidence to completely prove that the management judgment is right. So there is a lot of uncertainty involved. Because of this judgments, this is one of the issues which you face as an auditor, and that is why you provide reasonable assurance and not absolute assurance. The next N talks about nature of audit procedures. So with respect to audit, it's not practicable for you to look or go through everything. Let's say you take the example of ITC. In a day, crores and crores and crores of transactions happen. You think you can check the invoices of everything? Impossible. So everything is done on a sample basis. You cannot do everything. You cannot see everything. That is how your procedures as such are designed to. And sometimes there will be certain circumstances where management will not have the evidence, or you will not be in a position to obtain that evidence. So in these circumstances, it becomes a restriction for you, which, on account of which, you provide reasonable assurance and not absolute assurance. The next one is, it is not in the nature of investigation. So as I told you, with respect to investigation, you have all of the rights and powers. You can enter into the director's office or his or her personal residence and get the evidence, grab it from them and all that. So you have a lot of powers. Let's say investigation similar to that of a raid, right? You would have seen movies where you enter the politicians or MLAs or minister's house, and you can do a search or seizure or whatever that is. But that is not the case with respect to audit. In certain circumstances, if you're not able to get the evidence or they're not answering your questions, you cannot force it out of them. All you can do is just request, right? So it is not in the nature of investigation, so you cannot obtain absolute assurance. Next one is, S stands for actually future events. So future events does affect the business operations, but you cannot predict the future. And the next one is timeliness of financial reporting. So the thing is, audit is a post-mortem of your accounting process. Your accounting process ends, then only auditing starts. So let's say your financial year ends on 31st of March. They take around 15 days time to, prepare the financial statements, close it out and all that. And then after 15th April, only they give you the financial statements. Then you start. Let's say you take 2 months time to, finish off the audit and all that. So as time goes by, the value of information, it declines. At this day and age, people look for live updates. Let's say there is an information or a post or a news which is 2 days ago, it's considered to be old, it loses its value. So whatever is current or live, that is what is more important. So here you're doing a postmortem of historical information. The more time you take, it loses its value, and you also don't have a lot of time to perform or to complete this audit or to see everything. So these are the main reasons as to why you provide reasonable assurance and not absolute assurance. Okay. So NNIFT, nature of financial reporting, nature of audit procedures, not in the nature of investigation, future events, and timeliness of financial reporting. The next point or the next topic which we're going to discuss is benefits of audit. So as part of benefits, it helps three stakeholders mainly. So remember, around 5 to 6 points, that would be more than enough over here. So as part of those 5 to 6 points, the first one is, it helps the investors to take investment decisions. And then the second one, it helps the bank to take credit decisions. When I say bank to take credit decisions, it means bank can decide whether loans can be given or not based on what? Audited financial statements. Then it helps the government to determine something called as tax liability. So your tax is calculated based on the profit. So if the profit is audited and it is right, then the tax liability which is going to the government is also going to be right. So it helps three stakeholders: investors, bank, and government. The next thing, If anyone in the company knows that an auditor is going to come and check whatever they did, they get scared and they try to, start behaving properly. So that is why it acts as a moral check on the employees. And your main job as part of your audit to identify misstatements which can be due to fraud or error. And through this identification process, you ensure that the financial statement is of high quality. It provides high quality financial information. So these are, 5 to 6 points which you can remember and bring it as part of your answers. And if you ask me whether audit is mandatory or voluntary, it depends on case to case. For example, companies at the moment, it's mandatory for all of the companies. And in LLP, there are certain limits you have to follow. Whereas sole proprietorship, it is not at all mandatory, it is voluntary. Right? Only if a law regulation mandates audit, then only it becomes mandatory. Who appoints the auditor? Generally, in case of companies, it is appointed by the shareholders, and in case of government companies, it is your comptroller and audit general. In case of the sole proprietor, basically the business owner. In case of partnership or LLP, it's basically the partners who appoint the auditor. Yes, moving on to the last part of this chapter, which talks about assurance engagements and assurance engagement standards. Assurance engagements means nothing but the different types of services which you can provide as a professional chartered accountant. Right? Audit is not the only service which you can provide. There are a lot of other services, which is what is called as assurance engagement. So the definition, if you see, so basically, there are different things over here. So there are three parties involved: a responsible person, a practitioner, and an intended user. So the responsible person is responsible for preparation of a subject matter. The subject matter can be financial statements, quarterly financial statements, projections, it can be anything. Right? The responsible person, mostly it will be the management. They will be responsible for preparation of something. An intended user is going to take decision based on the subject matter. But can they rely on it directly? No. So you're going to call a practitioner, which is us. We will come and evaluate, obtain sufficient appropriate evidence for it, do certain procedures, and express our opinion in a written report. So this is what actually happens as part of assurance engagement. So broadly, there are 4 different types of assurance engagements. So the first type of assurance engagement is reasonable assurance engagement, which is audit, right? So with respect to the standards, assurance engagement standards, each type of service which you provide or each type of engagement which you provide, you will have to follow certain standards, because only if you follow standards, you'll know what to do. There is a benchmark, it ensures uniformity, you know actually what to do, right? So that is why we basically have standards. So for each type of assurance engagement, you'll have to follow different standards. So the first type of assurance engagement is a reasonable assurance engagement, which means nothing but audit. For this, you need to follow 2 standards. One is SA and the other one is SQC, standards on auditing and standards on quality control. The next one is limited assurance engagement. So here, limited assurance engagement, it applies to all of the listed companies where, the subject matter is basically quarterly financial statements, and you'll not perform a complete audit, you'll just review it. So over here, you need to follow standards on review engagement and standards on quality control. The next one is assurance engagement dealing with matters other than historical financial statements, where they're talking about projections or prospective financial statements. So basically, the management will have a 5-year plan or a 10-year plan, right? Which is basically called as projections. That, if you're going to audit, it comes in the third category. Over here, you need to follow SAE and SQC, standards on assurance engagement and standards on quality control. And the last one is other assurance engagement. Any other things which does not follow in these 3 categories, you'll have to follow other assurance engagement. For this, the standard which you need to follow is SRS and SQC. SRS full form is Standards on Related Services, and SQC, which is Standards on Quality Control. Please be very careful when they ask you NCQs. Standards on Quality Control is applicable to all types of assurance engagement, irrespective of what work is being done, because whatever service we provide, it must be of high quality. So SQC is it applies to all types of assurance engagement. So these are the 5 different types of standards, as I told you. SA, standards on auditing; SRE, standards on review engagement; SAE, standards on assurance engagement; standards on related services; SRS and SQC is standards on quality control. Why do we need, you know, standards? So the catchword is QBUS. B stands for providing benchmarks, Q stands for it improves quality, U stands for uniformity, and S stands for knowledge and skill. It upgrades our knowledge and skills. Right. Quality of an auditor. You as an auditor, what are the qualities which you're supposed to have? You need to be technically upgraded. You need to have a lot of patience. You need to follow integrity. You need to be very clear with respect to what you're asking. You need to have a questioning mind, which means you have to be skeptical. Yeah, all of these are the qualities which you need to follow as an auditor. So this is what is covered as part of chapter number 1. Okay. So, as we have finished off chapter number 1, we are moving on to chapter 2, which talks about audit strategy, audit plan, and audit program. So, the weightage of this chapter is around 8 to 10 marks. So, you can expect 2 questions from this. So, chapter 1 and 2 put together, it comes around for 12 to 15 marks. Right, quickly moving on. So, as part of this chapter, Essay 300, Planning and Audit of Financial Statements, is what is discussed. Right, so here we are going to discuss how do we plan and audit. So, your entire audit as such is divided into 3 phases: planning, substantive, and conclusion. When I say substantive, it means nothing but execution. Right, first you plan your audit and then you execute everything as per your plan. You get evidence, etc., etc., and then you arrive at conclusion and express the audit opinion in the audit report. Right, so as part of planning, what and all happens in the audit is what we're going to discuss. So let's understand the practical flow of audit. First, there is a company or entity. They are responsible for preparation of the financial statements. So once they are done with the preparation of financial statements, they will approach an auditor and they will ask if we can appoint you as our auditor. And then you have certain planning activities which you'll perform, which is called as preliminary engagement activities. Once you're done with that, you all will sign the engagement letter and then you will plan as to how you're going to do this audit. And then after that, you'll do your execution and arrive at the conclusion and give your report to the shareholders, audit report to the shareholders. So this is the practical flow which happens in an audit. Now, we are going to understand your planning of financial statements, audit of financial statements. So planning as part of audit, the planning phase as such is divided into 2. First one is your preliminary engagement activities and the next one is other planning activities. As part of other planning activities, it is nothing but your overall audit strategy and audit plan. So before moving on to what is preliminary engagement activities, what is overall audit strategy and audit plan, let's understand why planning as such is really required. So in life, generally, we always have a plan, right? We plan for everything. Similarly, in audit also, we'll have to plan. Why? Because it saves you a lot of time. You know ahead that this is what you're supposed to do and this is what you've planned to do and this is what you're going to do. So it saves a lot of time, energy, and the resources are well prepared. And let's say something goes wrong, you know what to do or what are the next steps which you need to take. So it saves a lot of time. That's the main reason why we have planning as part of audit, time as well as money. Right? Okay. Now, quickly moving on to your preliminary engagement activities, which is the first thing which you'll do as part of your audit planning. Now, when I say preliminary engagement activities, there are 3 things which needs to be done as part of preliminary engagement activities. So, the first one is with respect to performing procedures regarding client acceptance and client continuance. What does this mean? Performing procedures regarding client acceptance and continuance. It means trying to understand what is the nature of business, what business do they do, evaluating the integrity of the owners and the directors and the key managerial personnel and all that. So basically, in simple words to put it, it means nothing but background verification. Just because someone comes and asks you, can I be the auditor, you cannot immediately accept the appointment, right? So you'll have to do a little bit of background verification before you should know what you're getting into. So that is what you actually do as part of preliminary engagement activity. So you check the legality of the business, whether the business is legal or not, and then see what are the shareholders doing. Do they have a history of black money or money laundering, etc., etc.? Because if they are involved in any illegal activities and you become the auditor, then you'll also get caught. So it will become a problem for you as well. So you'll have to do a simple background verification. So that's the first procedure. The next one is evaluate compliance with ethical requirements. When I say ethical requirements, it mostly means independence, and you'll also have to evaluate your capabilities of being the auditor of the specific company or entity. So over here, you need to check whether you're independent, whether you're related to this client or not. Only if you're not related, then only you can be the auditor of this specific client. And you also need to have the enough resources or technology to be performing this audit. So that is second point. Once these two conditions are satisfied, both of these conditions are satisfied, then you'll go ahead and draft an engagement letter. So again, performing procedures regarding client acceptance and continuance, then evaluating compliance with ethical requirements, which talks about independence and capabilities of an auditor. Third thing is drafting an engagement letter. So the first point, client acceptance and continuance, it means that you'll have to perform all of these other background check, evaluating independence, both of these points. It's not that you'll have to perform only for new clients. No, every year you need to evaluate your independence, your capability, and check whether the business is legal or not. Because businesses keep changing, your team members keep changing, right? You will have to evaluate both these things for all of the engagements, be it a new engagement, a new client, or be it a recurring engagement or a recurring client. Right? So that is on the preliminary engagement activities. Once you're okay with the business being legal and you're capable and you have signed the engagement letter, the real planning of the audit as such starts. So what is being done actually as part of audit planning or other planning activities? So let's split it into two. One is establishing an overall audit strategy, and then with that strategy, you will develop a detailed audit plan. You establish an overall audit strategy, and using that, you'll try to develop a detailed audit plan. So there is a very thin line of difference between your overall audit strategy or the general meaning of strategy and plan. Usually, when you hear people say that strategy and plan, it seems like both are the same, but no, it's not. So for you to understand the difference, let's take the example of cricket and the captain of the team. They'll have to take a decision at the time of toss, right? They'll have to tell out or call out their strategy, or they'll have some strategy in their mind based on the pitch, based on the weather conditions, etc., etc. They'll have to decide whether they're going to bat or they're going to bowl or field or whatever you call it. Batting or bowling, they'll have to decide. So this batting or bowling, deciding between these two is called as strategy, right? And when I say plan, you have to have a mind map, a blueprint, a structure as to how you are going to achieve this strategy. Okay, fine, your strategy is bowling. If that is the case, what is going to be the plan? How am I going to achieve this? Okay, I have to decide on the bowling lineup. I have to decide on the fielding structure. I need to decide who's going to be the wicket keeper. I need to decide during the power play who's going to be standing near the boundary, the two people who are going to stand near the boundary. All of that needs to be decided. All of those decisions is taken as part of plan. So this plan is going to help you achieve the strategy which you have taken. So this is the thin line of difference between strategy and plan. Plan is, it tells you how to achieve the strategy, whereas strategy is just the overall framework. Fine. So this is the small difference between strategy and plan. So first, the auditor tries to establish an overall audit strategy. When I say overall audit strategy, it means, here the catchword is SDT. It means it helps the auditor to determine the scope, it helps the auditor to determine the direction, and it also helps the auditor to determine time. So SDT, scope, direction, time. When I say scope, you have to understand what is your limits and your boundaries with respect to your work, and what is the direction with which you need to move, and what is the time within which you'll have to complete, right? So this is on SD and T. And the next part here, this can be a 4 mark question because there are 4 points over here. As part of your overall audit strategy, the following decisions needs to be taken. Okay, strategy is there. When with respect to cricket, it's batting or bowling. With respect to audit, what is going to be my strategy? What decisions are you going to take as your strategy, right? Here, the catchword for that is MRRW. The catchword is MRRW. So over here, what they're trying to say is your entire strategy is based on the resources. How many resources you need, that stands for first R. The next R is how many resources you need for specific areas. When I say specific areas, it means high risk or complex areas where you might need an experienced resource or you might need an expert's opinion. So R, resources. How many resources do you generally need? That's your first strategy decision. Then the second one is resources for specific areas. Then how am I even going to manage, direct and supervise them? And W, when do I actually need them? So all of the decisions are relating to resources. So RR, MW, resources required for specific areas, when these resources are required, and how am I going to manage these resources. So other than the timing and scope, these are the other decisions which are taken as part of your overall audit strategy. Now, when I say overall audit strategy, you need to consider certain factors while deciding or while determining your overall audit strategy. What are those factors? What and all I need to keep in mind when I am going to decide on this is going to be my strategy or that is going to be my strategy. So the catchword for that is CRCPR. The catchword for that is CRCPR. C stands for characteristics of the engagement. When I say characteristics of the engagement, it means what is the nature, size, and operations of the specific business. How big it is. If it is big, then I'll be needing more resources. If it is a very small business, then I'll be needing less resources. So this factor affects my decisions relating to strategy, which is with respect to resources, right? The second one is with respect to reporting objectives. So what are your reporting objectives? So let's say, are you doing the audit for a listed company or an unlisted company? See, if it is listed company, you'll have to submit the audit report within 31st May. So you just have 2 months. Whereas an unlisted company, you have 6 months time. Till September, you have time to finish off your audit. So this reporting objective, so for what, under what regulations am I reporting? Depending on that, it helps you in deciding the timeline of the engagement. Then other C, consideration of certain factors which are going to affect or direct the engagement team efforts. So there are going to be certain things which is going to affect my engagement team efforts. First one is volume of transactions. So higher the volume of transactions, more resources will be required. So I need to know this or consider all of this factor when I need to decide my strategy. Then in case of any significant changes in the industry, or let's say the AFRF, applicable financial reporting framework, has changed, or any other developments which has happened, in that scenario, you'll be needing more resources. The next one, results of preliminary engagement activities, right? You would have performed preliminary engagement activity, background verification and all that. Based on that, you will know how much time and effort and number of people which will be required from your end to complete the audit. The last one, R stands for nature, timing, and extent of resources required. What is the nature of resources? When do you need them? And how many resources you need them to perform the engagement. So till now we have discussed actually 2 catchwords, MRRW and CRCPR, as part of this chapter. So these are the decisions which you need to take, and these are the factors which you need to consider while determining an overall audit strategy. Fine. Once you're done with deciding the timing, how many resources you need, how many specific resources you need, how many managers do you need to manage all of these people, and when these resources are needed, with that, the framework is over. Now you have to develop a detailed audit plan. In a detailed audit plan, it is going to tell you how you're going to achieve the strategy, right? So here, How are you going to use the resources? For what will each of the resources be doing? What is the individual timeline for each of the resources? All of this will be given as part of the plan. I repeat, how many resources you need is a strategy decision, but how am I what each resource will be doing is called as your audit plan. Overall timeline is example of a strategy, but individual timeline for each of the resources is called as audit plan. So as part of audit plan, I will decide what each of these resources are doing. How am I going to use these resources? What work am I going to assign to each of the resources? What are the timelines within which all of these people need to finish their work? I need to draft an audit plan and keep it so that everyone knows. So planning as such, what happens is when the audit strategy and audit plan is being discussed, they call all of the engagement team members, sit together and discuss the strategy as well as the plan. So your SA 300 tells that only when an audit strategy has been established, then only you'll be able to determine or develop a detailed audit plan. So as part of your audit plan, understanding the client's business is very, very important. Then you'll determine what are the nature, timing, and extent of risk assessment procedures and audit procedures which you need to perform. In simple words, it is you'll tell what procedures are going to be performed as part of the execution part. And here your audit plan is more detailed than the audit strategy. It tells you what are the individual timelines which the engagement team is going to do. So as I told you, the relationship between overall audit strategy and audit plan. Overall audit strategy is a very broad framework. It helps only with respect to scope, direction, and timing. Whereas with respect to audit plan, it tells us how your strategy is going to be implemented. How am I going to achieve the overall audit strategy? And responsibility for all of this planning activities, it is the auditor's responsibility to plan and work accordingly, right? And here, can the elements of audit plan or audit strategy be discussed with the management? Yes, not completely. Few parts or few elements of your planning can be discussed with the management. Whatever is needed to be communicated to the management, only those parts you will communicate to the management. Can changes be made in an overall audit strategy or audit plan? Of course, you make a plan. You have to study this now, then after 1 hour you'll be studying that, another 2 hours you'll be studying chapter 11 or whatever it is. But does things go as per our plan? Never. So because of that, you go back, change your plan. Right? Similarly over here as well, as you go on ahead with the audit, if you obtain any new information during the course of audit, in that scenario, you will have to make changes to your overall audit strategy or audit plan. But the only important thing as part of planning or anything in audit, everything needs to be documented because it serves as a proof or evidence to all of them. Let's say ICAI or National Financial Reporting Authority comes. So these two are regulatory bodies. So what they do is they are our heads. They they will want to know how well we are working. So they will ask us, for this project you did your audit, right? Give me the files. And they'll check whether we have done the audit as per standards or not. For that, in that scenario, we'll have to give them a proof. So if we document everything, we have a proof saying that yes, we have performed everything in accordance with standards on auditing. So documentation with respect to planning, you need to document the overall audit strategy, audit plan, and any changes which is being made to the overall audit strategy and audit plan and the reasons for such changes. Right here, why documentation is important is because it serves as a record for key decisions. So basically, you will not forget anything. Only if you document everything and keep, you can go and see, okay, there is a plan, I can go and see and I can perform the audit procedures. Okay. Another important thing which you do as part of your audit plan is prepare something called as an audit program. So an audit program is nothing but a series of verification procedures which is going to be applied on financial statement accounts. In simple words, it's nothing but the audit procedures and audit evidence which you will be performing. Right? Fine. It will be a master list for each account at an assertion level. What are the procedures? What are the evidence which you need to obtain? Who's going to be performing this? Who's responsible for this? What are the individual timelines? What is the status? All this will be there in one document, which is called as audit program. It is a detailed set of instructions. And this audit program, if you prepare for one company or entity, you can use that in the next year. But an audit program of one company cannot be used for all other businesses, because each company or business has its own nature of operations and size. So each varies in different aspects. So you have to prepare one audit program for each of the clients or engagements. So here they are telling that it's not practicable for you to develop one audit program, as each business varies in size, nature, and composition. Fine. As part of audit program, you have three headings. One is with respect to factors to be considered while drafting an audit program. Second one is advantages, and the third one is disadvantages. So first one, factors. Okay, you're going to draft an audit program as part of audit plan. I told you know what each resource needs to be doing. Where will that be? In an audit program. When will you prepare? During audit plan. So you'll, while you're drafting this audit program, you need to consider certain factors which you need to consider. So you need to consider certain factors while drafting this audit program. So the catchword for this is swear. Stay within your scope when you're determining the procedures. The other S, the steps, whatever you're going to perform, or the verification procedure, whatever you're going to perform, it must be useful. Then W, it must always be written. All of this should be written. It must be a written audit program. E, evidence must be reasonably available. Whatever is available, that evidence only you need to ask. You cannot go and ask some evidence from 1956. You have to consider all possible errors while drafting an audit program. You need to consider the audit objective while drafting the audit program, and you need to coordinate the procedures for related items. When they say related items, for example, fixed asset depreciation. Both are related items. Fixed asset will be in balance sheet. Depreciation, accumulated depreciation will be in balance sheet, but depreciation charge for the year will be in P&L. Even though they are two different accounts, you need to set one set of procedures for both these accounts, because they are related to one another. Please don't have separate procedures for depreciation, separate procedures for fixed assets, because it will waste a lot of time. Another example is fixed deposit and interest income. Both these are related, so you will have one set of procedures for this. Next, moving on to advantages of audit program. What are the advantages? The catchword over here is star IGCC. So S stands for systematic manner. It helps the audit to happen in a very systematic manner. Then T. T stands for total perspective. It provides a total perspective of actually what's happening in that audit. A. It helps in selecting the assistants and allocating the work to each of the assistants, because you know what work needs to be done. And R. Because you are making or tagging each assistant to one job and it is documented, it ensures that these people are taking up responsibility. I. It provides a clear set of instructions to all of these people. G. It acts as a guide for not only current year but also for the succeeding years. Then C. The principal or the auditor has a control over the progress of work, and it acts as an evidence in case of charge of negligence. When I say charge of negligence, it means ignorance. When someone accuses the auditor saying that he didn't do this procedure, he's ignorant, you have an evidence, which is your audit program. You can show them and say that, no boss, I have done all of the procedures as per standards on auditing. So these are the advantages. Next one is disadvantages. What are the disadvantages? Because you have one clear set of instructions, your work becomes too mechanical, because you have to just follow the instructions, and it becomes too rigid and inflexible for you. Right? And inefficient assistants, these lazy people, they take shelter behind the audit program, and they'll be like, whatever is there in that only I'll do. I'll not go beyond, above and beyond. And the other one is, it kills the initiative of efficient assistants. So there will be a lot of people who want to do more, but they are blocked by this audit program. How can you overcome or remove all of these advantages? You can have an imaginative mind. You must have a receptive attitude based on whatever issues are thrown at. You cannot just stay silent or mum. You have to react accordingly, and you have to go and tell your principal in case of any issues, right? Okay. So this is what is covered as part of chapter 2. It mostly talks about preliminary engagement activities, audit strategy, audit plan, and audit program. So preliminary engagement activities, three things: performing procedures regarding client acceptance and continuance, evaluating compliance with ethical requirements, preparing an engagement letter. Then audit strategy, it helps the auditor to determine SDT, scope, direction, and timing. The decisions taken by them as part of strategy is MRRW. How am I going to manage the resources? How many resources do I need? How many resources do I need for specific areas, and when I need these resources? I need to consider certain factors while deciding about my strategy, which is CPR. And as part of audit plan only, I prepare my audit program, which is a clear set of instructions which is going to help the assistants to perform the audit. So moving on to the last part of the revision, which is chapter 3, risk assessment and internal controls. So here again, 1 or 2 questions will be asked for around 8 marks. So as part of this, there are around 3 standards: SA 315, SA 320 and SA 330 and a little bit about internal controls, which we have discussed. A brief about what internal controls are and why internal controls are there. And then we have audit in an automated environment, and what about the information technology which is being used, right? Quickly moving on to the different types of risks which are there in an audit. First one is audit risk. Audit risk means risk of giving an inappropriate. Risk means what? Uncertainty, right? A risk that an auditor gives an inappropriate audit opinion when the financial statements are materially mistaken. Basically, what are they saying? You have expressed an unmodified opinion, but actually there are misstatements in the financial statements. There is always this risk. This is called as audit risk. Why? Because you provide reasonable assurance, you do all of your procedures based on samples. So there can be circumstances or risk where there are misstatements, but you didn't identify it, because of which you're expressing an unmodified opinion. Right? How you can reduce your audit risk is, you project your misstatements, right? In that way, even though a sample is not tested, you try to project it for the untested population. So that is one way in which you can reduce the audit risk. So that is actually divided into 2 things: risk of material misstatement and detection risk. So when I say risk of material misstatement, it means risk that a material misstatement exists in a financial statements. So it can be in an overall FS level or at an assertion level. This ROM is further divided into inherent risk and control risk. So if you take one particular account, inherently what is the risk that a material misstatement will occur? How weak that account is, just by considering that account without internal controls. When I say control risk, whether the controls are operating effectively and whether the controls are able to prevent, detect and correct misstatements. So that is called as control risk. And when I say detection risk is risk that your audit procedures, whatever you're performing, you're unable to reduce the audit risk to an acceptably lower level, and you're unable to detect misstatements which can be material either individually or in aggregate. So that is another type of risk. Then comes your sampling risk, where whatever conclusion you're forming based on your samples, it is not representing the entire population. That is called as sampling risk. Non-sampling risk means you are reaching an improper conclusion, but it has nothing to do with the samples. It is because of your own professional judgment. That is what is called as non-sampling risk. Now, if I have to group it as a flow chart, this is how it will look. Audit risk. What is the overall audit risk? Risk that you will express an inappropriate audit opinion. What is an inappropriate audit opinion? What is that circumstance? Where you've expressed an unmodified opinion, however, there are misstatements in the financial statements. So that we are further dividing into 2 parts: risk of material misstatement and detection risk. This detection risk, what are they trying to tell? They're trying to tell that there are you're unable to detect misstatements in the financial statements. Excuse me. So you're unable to detect misstatements in the financial statements. It can be due to sampling risk or non-sampling risk. Now, when I say risk of material misstatement, risk that there exists a material misstatement in the financial statement accounts. Inherently, how weak is that account? Or even if controls are there, it is unable to prevent, detect, and correct misstatements in the financial statements. So let's say I'm there and I'm playing cricket. Let's say I'm really weak, not able to pay. Then my inherent risk will be very high. However, if I'm, placing, the pads, shoulder pads and all that while playing cricket, so there is a lot of protection. That is called as controls. If that is of good quality, then my controls are able to prevent, detect, and correct all of these issues. But if it is of low quality, if it is of no use, then the control is also not working. So overall, the risk of material misstatements will be very high. So actually in SA 315, it's a very small standard. Here what they're trying to tell is, for each account and also for the FS as a whole, you need to identify what is going to be the risk of material misstatement. And based on that risk only, if it is high, you'll perform further audit procedures and you'll perform more audit procedures by selecting more samples. But however, if the risk is low, you'll be performing less number of audit procedures. So how are you going to assess this risk of material misstatement? How will you know whether the inherent risk is high or low? How will you know whether the control risk is high or low? So here you will perform something called as risk assessment procedures. So you'll try to, so risk assessment procedures is a combination of all these three. Inquiry, by seeking information from knowledgeable person, and you perform analytical procedures, you observe and you inspect, and you get a lot of information. Through this, you'll be actually be able to assess the inherent risk by performing risk assessment procedures. And how will you know the control risk? By performing the test of controls. So through risk assessment procedures and through test of controls, you will be able to determine what is going to be the risk of material misstatement. Then only you will be able to enter into your execution phase and perform your substantive procedures. Right, this is what is covered as part of SA 315. Now moving on to SA 320, which talks about materiality in planning and performing an audit. So materiality is nothing but an individual threshold set by the auditor. Right? Why do they set something called as materiality? It is to, so that you have a threshold to prioritize what accounts needs to be dealt with first, what misstatements need to be dealt with first. In addition to materiality, there is something called as performance materiality. So when I say performance materiality, what are they saying? It is an amount set by the auditor lower than the materiality, and this is done to reduce the probability of aggregate of uncorrected and undetected misstatement to exceed the overall materiality. An amount set below the overall materiality to reduce the probability of the aggregate of undetected and uncorrected misstatements exceeding the overall materiality. For example, let's say my materiality is 100. Your performance materiality will be always lower than your materiality. Let's say that is 80. So for any of your audit procedures, you will actually be using the performance materiality of 80. Why? Because they want to have a buffer for undetected misstatements. So for any detected misstatements, you'll use the threshold of 80. And lower the materiality, the more cautious you are, and you will try to correct everything. So they want to have a buffer of 20 so that in future, if police or someone investigates and identifies a very big issue, you can say that, boss, this is only 18 crores. I already have a buffer of 20 crore for undetected misstatement. So overall, it is not exceeding my overall materiality. Hence, I have not performed any audit procedures or obtained any audit evidence. So this is just for your own safety. They have introduced an additional threshold lower than your materiality called as performance materiality. It is usually a percentage of your performance. It's usually a percentage of your overall materiality. Right. Again, determination of materiality is actually based on the professional judgment of the auditor. Right. Now, how are you going to set your materiality? So it's actually a percentage of a benchmark. Benchmark means a number from the financial statements. It can be either your revenue, or it can be your expenses, or it can be your assets, or it can be your equity, or it can be your liability, or anything, right? You have to decide a benchmark, and then on that benchmark, you have to apply a percentage. Now, how are you going to decide what is going to be my benchmark, whether it's going to be revenue, expenses, assets, or whatever it is? Catchword for that is Innova. Assess all of the elements of the financial statement. So E stands for elements. And N, understand the nature of the entity. Is it a trading entity? Is it a manufacturing entity? Try to understand the nature. Understand the ownership structure. And understand what is the volatility of the benchmark, how frequently the benchmark value as such changes, and evaluate in which account the users of the financial statement gives a lot of attention to. That is going to ultimately be your benchmark. Let's say if the users of the financial statements or the shareholders are bothered about profit, then profit is going to be the number. If it's revenue, then revenue is going to be the benchmark. And your materiality is a percentage of that benchmark. Right. The next thing is whether materiality is going to be only for financial statements, or can we determine materiality, a different materiality for specific financial statement accounts. So the standard tells ideally it should be just materiality and performance materiality. But in certain circumstances, if you feel that the risk is high in certain areas, for those accounts alone, you can have a separate materiality and not follow the common materiality. Right? The examples are, let's say, with respect to related party transactions, or it's relating to a very key disclosure, or the focus is with respect to that account only, and the users are very, very mindful of that. In that scenario, you can set a separate materiality. So the standard SA 320 does allow. The next thing is revision of materiality. Is revision of materiality possible or not? Definitely it is possible. If you obtain any new information, or there is any change in the circumstance, or change in understanding of the auditor, in all these three scenarios, you can make a change to your materiality. But it is very, very important to determine the reason for the change, right? And what do you need to document? You need to document your materiality, your performance materiality. In case you have any different materiality for a specific class of transaction, account balance, or presentation and disclosure, you need to bring that in, and any revisions made to the above, you need to bring in, and the reasons for the change. And you need to understand that the last part of the standard, there exists a very, very inverse relationship between materiality and audit risk. Audit risk expressing an inappropriate audit opinion when the financial statements comprise of material misstatements. Higher the materiality, there exists, okay, so higher the risk, lower will be the materiality, so that you will test more. If risk is very low, then you will keep a higher threshold. So there exists an inverse relationship. The next part is internal controls. So here they are talking more from a management angle. So here is where you need to split the chapter. First, SA 315 and 315 and different types of risks, which is discussed as part of SA 315, all was given in the standard. So we have to assess the risk. Based on that only, I will be able to determine more samples or less samples. So perform risk assessment procedures through inquiry, observation and all that, and assess the inherent risk. Control risk you try to assess by performing test of controls. Then after that, you will have to perform substantive procedures. Right? That and all is fine. You have to select samples and test it. But with respect to an internal control, who is responsible for it? How is it going to be implemented? How should I even understand this internal control environment? All that is what we are going to discuss now. So again, it is a process which is being established by your management, and they're trying to achieve reliability of financial statements. They're trying to bring in effectiveness and efficiency of operation. They're trying to safeguard the assets, and they're trying to comply with laws and regulations. So basically, there are different aspects, but we are bothered only about the reducing the or increasing the reliability on financial statements. In other words, it means trying to prevent, detect, and correct misstatements. But other than that, not only with respect to financial statements, they want to make the operations more better, and they want to ensure that they are following laws and regulations, and they also want to safeguard their assets. For all of these, they implement something called as internal controls. So why do we have to understand and test the internal controls? Because it helps us where and all misstatements are possible, what and all are the factors which affect the risk of material misstatement, and it helps me in determining what is going to be the nature, timing, and extent of the audit procedures. It helps in assessing risk. So higher the risk, higher will be the nature, timing, and extent of audit procedures. Okay, fine. The internal controls, it helps me or helps the management in prevention, detection, and correction of misstatements, safeguard of assets. All that is fine. But what are the limitations? Again, even if the controls are established, human beings are involved. So error is possible. It can only reduce the risk. It cannot eliminate or eradicate the risk. So human judgment is involved. Let's say people are not understanding the purpose of these controls. They don't follow. In case of smaller entities, they don't implement these controls because it takes some money, and people also don't want to follow, right? All these are the different types of limitations of internal controls. Now, as part of this internal controls, what are the different angles or elements to it? First one is the control environment. When I say control environment, you'll have to visualize as if you're sitting in an office, in a corporate office. How does the upper management as such follow the controls? How are their ethics? How is their commitment to following the internal controls? How is their operation style? Are they good disciplined people who want to follow the internal controls? If that's the case, then the control environment is really good and your risk will be low. But if they're lazy people and they don't care about internal controls, that's the kind of attitude which they're giving, then the control environment is not that great. Right. Then the next point is entities risk assessment process. See, we independently identify the risks. Similarly, management also, they themselves need to identify risk. Oh, here there is a lot of risk, so I have to implement a check or a control. How well they perform this process on a periodic basis. If they perform it really well, then good. If not, then you have to automatically increase your risk of material misstatement. The next one is with respect to your information system. So what are the different systems? See, nowadays for accounting, we are not using your ledgers and notebooks, etc. So there are a lot of ERPs, enterprise resource planning, or it is also called as accounting software, your SAP, Tally, Oracle. How well the information system is being set up? Is it well secured, well put, a very good quality information system? That is the case, then the controls will also be followed properly. But if it's not that great, anyone can access anything, and it does not capture the transactions properly, or the quality is not good, or there are a lot of errors within the system itself, that case the controls are not that great. Then the control activities mean it talks about nothing but the policies and procedures relating to the human resources and how well the duties are segregated among the people. Last one, monitoring. Again, it's not enough if you just implement internal controls. You'll have to always have a monitoring mechanism. If all these are there and if it is well and good, then the internal controls are operating properly, and your risk of material misstatement will automatically be low, and you'll select low samples, and it will be less, you'll be needing less time to complete the audit. So this has a very direct impact on our financial statements. Right. Then how can you evaluate these internal controls? So there are different methods which you can use to evaluate the internal controls. First one is called as a narrative record. So you're trying to maintain details of how the control as such is implemented and how it is being followed. So you perform something called as a walkthrough. You sit with a person and try to understand the entire process. Basically a complete description of what actually happens, or a checklist. You have a set of questions and you just have to fill in a checklist. Through that, you'll be able to evaluate the internal control. Or you come up with a comprehensive set of questions and inquire with the management and get answers to that question. Or that entire control, if you present it in the form of a flow chart. Through this, you can evaluate whether the internal controls are proper, whether it's serving its purpose or not. Then as part of internal controls, I told you have to test controls, right? It is called as test of controls. So in test of controls, you need to evaluate two things. One is called as operating effectiveness. The other one is called as design effectiveness. Design effectiveness means whether this control is addressing a specific risk. So there is a problem. Is this control addressing the problem? If that is the case, the design of that control is good. The control is addressing the risk, but it is not at all operating. It means, or it is not at all being followed. That is called as operating effectiveness, whether it is being followed or not. Design means whether the risk is being addressed by the given control. So you need to see it from two angles, and then you'll have to give a conclusion. So even if one is not satisfied, either design effectiveness is not there or operating effectiveness is not there, you'll call it as a deviation or you'll call it as a deficiency. Right. Now, in case of an automated environment means, as I told you, accounting systems are maintained in information technology. Here also there are a lot of risks with respect to IT system, where whatever data is being captured by the system is inaccurate, or unauthorized changes are being made, or a lot of access is given to a lot of people, and the one who is reviewing is approving. There is no proper segregation of duties, or if changes were requested to be made and they are not made. All these are risks with respect to IT related, which is the systems which are followed. So here there are three different types of controls which actually can be implemented for information technology. Basically that software or that system or the laptops, you can establish three types of controls, which is called as general IT controls, which talks about user access, segregation of duties. So here when I say general IT controls, it means access for Tally or SAP can be given only to two people. A lot of people will not be given access. One will have a view only access and the other one will only one person will have edit access, and there will be a password, and the password will keep on changing on a weekly basis or on a monthly basis. These are all called as general IT controls. And with respect to application controls, with respect to each specific application, they will have a control. It varies from case to case basis. And IT dependent controls means you are performing a control, but the report is extracted from an IT application, and that scenario is called as an IT dependent control. So over here we were actually talking about internal controls, right? How to evaluate the internal controls, and we were discussing these internal controls should also include the IT controls, basically general IT controls, application controls, and IT dependent controls. All these needs to be included as part of your understanding of internal controls. Why? Because your application which you're using is very, very important, because only from that they take the ledger, trial balance, and with that only they're preparing a financial statements. So your entire source data is coming from the application. So it is very, very important for us to evaluate this. But the only catch over here is we all are not professionals to be testing the applications, whether it's operating properly or not, whether it is designed properly or not. There are a lot of coding and all involved. So usually we take an expert's help, an IT person or an IT expert's help to help us in understanding the IT related controls. Right. Fine. And there is a small topic called as data analytics. So data analytics means where you're trying to perform analytical procedures only, but using an automated tool. So basically how a data analytics as such works is you get the population of all of the journal entries and you import it into an application. And through that application, you'll be able to generate a lot of reports. One of the example is you'll be able to generate something called as day-wise reports. Let's see, on Monday, how many entries were posted? Tuesday, how many entries were posted? Wednesday, Thursday, Friday, Saturday, and Sunday. Risk is focused more towards entry posted on weekends. So you will select samples only from the entries posted on Saturdays and Sundays. Right? So first the population is being uploaded. Then you will be selecting samples. For each of the samples, you will either recompute or you will reperform any calculations, or you will try to analyze what is the type of journal entry. If it is posted on a weekend, is there any fraud which is happening into the business, and see if any controls are not being followed. So actually data analytics helps us in generating a lot of reports automatically. It's just a tool where you upload the entire journal entry data and you'll be able to extract different reports, right? So this helps us in performing analytical procedures, and it also helps in focusing on the risk based area and selecting samples only in the risky areas, so that we finish our work more faster and try to evaluate and focus more on the risk-based areas. So the last standard as part of this chapter is SA 330. What are the responses or auditors' responses to the assessed risks? So over here, first, auditor performs test of controls. I told you risk assessment procedures and test of controls, right? In order to determine the risk of material misstatement. Once that is done, then only you'll be performing substantive procedures, right? You'll be performing substantive procedures. That is divided into two. One is test of details, where you inspect the invoices, inspect the documents, inspect the supportings, or you can overall try to analyze the balance as a whole by performing substantive analytical procedures. Test of details means you verify the balances or verify the transactions. That is what is called as test of details. And with respect to test of controls, you try to inquire and understand and evaluate the design effectiveness and operating effectiveness, right? So this is what is covered as part of your chapter 3. So as part of the revision, we have covered chapter 1, 2, 3, 4, 6, 7, 8 and 11. So as part of chapter 10, see, in a lot of alternate attempts, what I've noticed is they have repeatedly asked questions with respect to drawing power calculation. It can be either a 4 marks or a 5 mark question. So if you have the time, spend at least 5 minutes to cover your classification of performing and non-performing assets and provisioning, and also the drawing power calculation. It's not theory based, again, it's sums based. So it will be easier for you to quickly grasp. And with respect to chapter 9 and 5, general questions are being asked, and sometimes people in exams, they're alternating between chapter 9 and 10. So that is about the audit revision. Best of luck for your exams, and have a great day. Thank you. Okay, the next chapter which we'll be discussing is chapter 4, audit evidence. So there are around 3 to 4 questions which is being asked in exams, and the mark weightage is close to 15, or it ranges from 12 to even 20 marks. So another very, very important chapter. This is the sole chapter which has the highest weightage. A very important chapter, and there are a lot of standards also which is being covered over here. So we have, it starts with SA 500, then you have SA 501, and then we have SA 505, and then SA 510, and then SA 520, SA 530, SA 550, and SA 610. So there are around 8 standards, and we're going to discuss each of them. The first one talks about audit evidence. So we're going to discuss SA 500, audit evidence. Audit evidence is nothing but any information which is being used by the auditor to arrive at audit conclusions, based on which the opinion is going to be based, is what is called as audit evidence. So basically, you'll obtain information. Based on that, you will have certain conclusions, and with that conclusion, you're going to form an audit opinion. So let me be very clear over here. Audit conclusion and audit opinion are two different things. Audit conclusion is conclusion for each financial statement accounts. For one account, you'll be having an audit conclusion, and all put together for the financial statements as a whole, you'll be having an audit opinion. So any information which you get during the course of audit to arrive at a conclusion is what is called as audit evidence. It also includes the accounting records and the books of accounts which you obtain. So sources, where does it usually come from? There is an internal source as well as there is an external source. Internal source means any information which you obtain from the management. External source means anything which you obtain outside the company or the entity, not from the management. And depending on the nature, there are different types of audit evidence. It can be in documentary form, it can be in visual form, or it can be in oral form. And audit evidence, they expect it to be sufficient and appropriate. Always an evidence is accepted to form a conclusion only if that audit evidence is sufficient and appropriate. When I say sufficiency, it means the quantity of audit evidence, whereas when I say appropriate, it means nothing but the quality of audit evidence. Sufficiency is a measure of quality, whereas appropriateness is sufficiency is a measure of quantity and appropriateness is a measure of quality. Appropriateness is again further divided into relevance and reliability. Relevance means logical connection between what procedure you're performing and what evidence you're getting. So whatever procedure you're performing, relevant to that, you need to obtain audit evidence. And reliability means nothing but the trust which you can place on that specific document. So it is influenced by the source, nature, and circumstance in which it is obtained. So always in exams, please don't use audit evidence. Try to use the term sufficient and appropriate audit evidence. Both whatever quantity of audit evidence you ask, that much they should give, and whatever audit evidence, like let's say you're asking for bank statements, they're supposed to give you bank statements, which is the relevant evidence and not some other evidence. Now, moving on to the reliability of audit evidence. Here, reliability means, as I told you, the trust which you can place on the document. And this trust, it can be influenced by the source, nature, and circumstance in which it is obtained. When I say source, it means internal, external. When I say nature, whether it is oral, visual, or documentary, and in what circumstance in which it is obtained. So they are telling in 5 scenarios, the reliability increases. Usually, instead of obtaining any information from the management, if you obtain it from an external source, it is more reliable. Why? Because why are you obtaining evidence? You have a financial statement, you have a number. You need to say whether it is true and fair, whether it is free from material misstatements, which can be due to fraud or error. How will you say that? By obtaining evidence. The number, if the number is also from the management and the evidence is also from the management, then sometimes it might not be reliable. So usually external sources are more reliable. So the first one is if it is obtained from independent sources or external sources, and you have to go and directly obtain it from that independent source. And whatever evidence you are getting from the independent source, it must be in documentary form, because oral form and visual form, you cannot retain it. That is the problem. Only if it is in documentary form, retention is possible. So any evidence you get, only if you retain it in documentary form, the reliability is more. And you have to obtain the original documents, and in case it is obtained from an internal source, the internal controls must be operating effectively. Only these circumstances, the reliability increases. Again, you can, first 4 points, it is like a story. You have to obtain it from an external source, and you have to directly go and obtain it from that external source, and it should be in a documentary form. That document must be original. However, if it is from an internal source, the internal controls must be operating effectively. So for the past 1 hour or so, I've been continuously talking about internal controls. What are these internal controls? Who is going to implement it? What is this internal controls? Let's briefly understand what internal controls as such means. See, the ideology behind internal controls is, let's say I'm the management. I have an external person called as auditor coming and checking my financial statements and pointing out the mistakes. Boss, you have done this wrong, you've done that wrong, there are a lot of misstatements and all that. I don't like it. We as human beings don't really like it when someone else comes and points out my mistakes. Right? Similarly, the management didn't like it. So the Companies Act introduced something called as internal controls. So it got mandated only in the recent years, from 2013 or 2015. So the ideology behind that is, internal controls means nothing but certain rules which the management implements to ensure that nothing goes wrong in the business, or nothing bad happens to the business, or there is no misstatements in the financial statements. So even before the auditor comes and identifies, I have proper rules, I have proper checking mechanisms to ensure that there are no misstatements in the financial statements. So before the auditor comes and identifies it, I will try to prevent, detect, and correct my misstatements through this internal controls. So even before they come and check, I have implemented a mechanism similar to that of quality controls, that is for auditors. For us, For the management, it is going to be internal controls, rules and checks established to prevent, detect and correct misstatements. One of the example is, let's say there is a control. Every journal entry beyond 5,000 rupees will be reviewed and approved by the CFO. This is an example of an internal control. When I say that every journal entry beyond 10,000, let's say 10,000 is their materiality, or it is a very huge transaction. So what they're trying to say, any journal entry will get posted only if it is approved by the CFO. They'll see what is the debit, what is the credit. See, they're not waiting for the auditor to identify. When even before the entry is posted, they're checking debit, credit, is it correct account, amount, is it correct? Do they have a proper source document and an invoice or a bank statement for that? Only after the CFO checks all of it, only then the entry gets posted. So this is an example of an internal control. Through this, mistakes are identified earlier. Mistakes means misstatements, right? Misstatements are identified at an earlier point and corrected by the management, right? So this is the whole concept of internal control. So if they have internal controls, then here what they're saying is, if you obtain it from an internal source and they have internal controls, you can rely more on these evidences. So these are the scenarios or circumstances where reliability as such increases. And the next topic is, what are the factors which affect the quantity of audit evidence? As in, if these factors are present, either I'll have to obtain more audit evidence or I'll have to obtain less audit evidence. The catchword over here is MRS. M stands for materiality, R stands for risk of material misstatement, and S stands for size and characteristics of the population. Over here, by materiality, they're not actually talking about the threshold. They're talking about the value of that specific account. And when they say risk of material misstatement, what is the risk of material misstatements existing in this account? Is it high or low? Size and characteristics of the population. Over here, they're talking about the volume of transactions. To explain it in just one single term, higher the value, volume and risk, higher will be the quantity of audit evidence which you need to obtain. So if the value of the account, let's say I'm comparing 100 rupees account balance with 10,000. Let's say I'll select more sample in the 10,000 account, 10,000 related account balance, and if the value is very less, I'll need lesser audit evidence. And if there are a lot of transactions, for a lot of those transactions, I need to obtain more audit evidence. And if the risk is also more, then there will be a possibility of a lot of material misstatement. In that scenario also, I'll have to obtain more audit evidence. Right. You have to perform certain audit procedures to obtain the audit evidence, or you have to perform these audit procedures on the audit evidence obtained. I'll repeat. Either you perform certain audit procedures to obtain the audit evidence. For example, inquiry. Only if you ask, they'll give you the information. And sometimes you'll have to do audit procedures on the evidence obtained. For example, inspection. Right? You inspect the bank statement or any evidence, documentary evidence which you have received. So the catchword for this is ICAIORR. So it is ICAIORR. I stands for inspection, where you are examining a document or any invoice. C stands for external confirmation, obtaining a direct written response from a third party. This we are going to discuss in detail as part of SA 505. Analytical procedure. Evaluation of financial information by establishing a relationship between financial and non-financial data and evaluating the identified fluctuations. This we'll discuss as part of SA 520 shortly. Inquiry means you're asking information from knowledgeable person. It can be internal or external. In this case, you'll receive oral form of audit evidence. Observing means looking at a process or procedure being performed by others. For example, physical verification as part of SA 501, we'll know that we have to observe the physical verification which is being performed by the management. R stands for recalculation, which means checking the mathematical accuracy. For example, depreciation recalculation. Re-performance is independently executing a procedure which was originally performed by the entity. For example, BRS. BRS is a process which is already performed by the management, but over here you are re-performing it, right? If you're re-performing a process as a whole, you're doing it again, it's called as re-performance. But just one small calculation, you're doing it again, it is called as recalculation. So all of these procedures are performed to obtain evidence, or it is performed on the audit evidence obtained, right? And one small point over here is inquiry alone does not provide sufficient appropriate audit evidence. You'll have to perform additional audit procedures to obtain sufficient appropriate audit evidence, right? One another important topic which is covered as part of SA 500 is assertions. Assertions are nothing but representations made by the management embodied in the financial statements. So management are trying to make representations in the financial statements, right? What type of representations is what we are going to see. So the P&L accounts are called as classes of transaction, and the balance sheet accounts are called as account balances, and your notes to accounts is called as presentation and disclosure. So these are the different names. Instead of calling it as balance sheet, instead of calling it as P&L, instead of calling it as notes to accounts, it's called as P&L is called as classes of transaction, balance sheet is called as account balance, notes to accounts is called as presentation and disclosure. So in case of P&L items, management is trying to tell you 4 things, or they're trying to tell 4 statements. Whatever revenue or expense or income or whatever is there, it actually occurred. Whatever is being presented is the complete list of transactions which happened, and the value is accurate, and the period for which it has been accounted is correct, and the classification of whether it is income or expense is also correct. So these are the 4 or 5 different statements which a management is trying to make. See, when you see the financial statement and you see the amount, audit is not only about the amount. When I say revenue is 500, they're trying to say that revenue really occurred. All of the revenue is accounted, and the amount which is being presented as 500 crores is correct, and the period for which the revenue of 500 crores is accounted is also correct, and the classification of this as income is also correct. So when you just see this one line, revenue 500 crores, they're trying to make 5 different statements to you. So you have to assume that the management is trying to represent all these, or is trying to make all of these statements to you as chartered accountants. So one account, you slice it into 5 parts or 4 different parts and see it in different points of view. That is actually what is called as assertions. So any procedure you perform or any evidence you obtain, it needs to be at an assertion level and not at an account level. When I say account balance, it means nothing but balance sheet. So over here, balance sheet, when they say there are certain assets or liabilities, they are trying to tell who the management. They're trying to tell that, yes, this asset or liability actually existed, and whatever is being accounted, it is complete. All of the complete list of transactions are included over here. The valuation, whatever the asset or liability is valued, it is correct. And in case of assets, the company has rights over the assets, or in case of an obligation, it is the company's obligation. These are the 4 different statements which the management is trying to make. In presentation and disclosure, you kind of have like all of the above. Additionally, you will have something called as understandability, right? Whatever is presented in the notes to accounts, you are able to understand the picture of the financial position and financial performance. So that is what is covered as part of assertions. Once again, any account you take or anything in the financial statements you take, you have to try to see it from different angles or different points of view. You slice the account into 4 or 5 different points of view. Each point of view is trying to tell each statement, and each statement is called as an assertion. The different representations or statements trying to be made by the management, which is already embodied in the financial statements, right? Okay, let's say for example, revenue. What statement they are trying to make? The revenue has been recognized in the P&L. Whatever revenue is recognized in the P&L has really occurred, which means they are trying to talk about occurrence. Whatever revenue showed in the financial statements is complete, which means they are talking about completeness. Whatever revenue is disclosed in the financial statements is correct. Here they are talk about accuracy or measurement. And it is recognized in the appropriate period, it is cut off. And the classification is appropriate, it means that it is talking about classifications. Then there is a small topic relating to Audit trail. Audit trail over here means nothing but a complete flow of transactions relating to one event, right? Let's say you sold goods on credit. Then, so the first entry will be the credit sales entry, and the next entry will be with respect to collection. These two entries put together is called as flow of transactions. A documented flow of transactions is called as audit trail. It is a specific requirement of the Companies Act. So every company, they're supposed to have a step-by-step detail and flow of all of the transaction, and they need to maintain the records and documents of all of these flows of transactions. Again, a very small topic. Then, fine. There is an important point which we need to discuss. In case of any doubts over the reliability of audit evidence, if you are doubting the trust which you can place on the audit evidence, in that scenario, you need to express a modified opinion. So when I say modified opinion, so quickly shifting to chapter 8, there are two types of opinion: unmodified opinion and modified opinion. When I say unmodified opinion, it means good opinion, where the financial statements are free from material misstatements. When I say modified opinion, it means it's a bad opinion, where the financial statements are actually not free from material misstatements, which can be due to fraud or error. Basically, it does not present a true and fair view. Right? In case you have doubts over the reliability of any evidence which you obtain, you're questioning, the trust. In that scenario, you can express an audit modified opinion. Next scenario, what they are trying to tell is, so here, in case of a management expert, how are you going to obtain audit evidence? So a management expert is nothing but an individual or an organization who has expertise in a field other than accounting or auditing, and who has helped the management with respect to preparation and presentation of financial statements. So here two aspects. It's an individual or organization. Okay, fine. We are not worried about that. But they have an expertise in a field other than accounting and auditing. Let's say law, let's say science, let's say maths or statistics, anything. And they have also helped the management with respect to preparation and presentation of financial statements. For example, in case of any litigations means legal cases. In that scenario, we need the help of lawyers. Why? Because in case of a litigation, we need to check whether the company has to make any settlement, for which we need to create a provision, right? Provision for litigation. So for that, we need to know the probability of winning or losing. See, if you're going to win, then you need not create any provision. But however, if you're going to lose, in that scenario, you will definitely have to create a provision. But can you and I, be the management or auditor, tell? No, you'll have to go to a legal expert. That person is called as a management expert. So he is the one who's going to tell whether the management is going to win or lose the case, and he'll also help us with what is the compensation which is going to be paid, because he would have seen or she would have seen a lot of cases. So they will help us with the provision amount, not us, the management. Right? In this scenario, I cannot go and ask the evidence from the management. I'll have to reach out to the expert. So in this scenario, what are you supposed to do as per SA 500? So here what they are telling, your audit procedures may be affected by a lot of matters or a lot of factors. If the matter is very complex, then you'll have to spend more time to understand. If the risk is very, very high, you'll have to spend more time. You have to check whether any alternative sources of evidence is available, because if alternative sources are available, you try to go and get additional comfort over that. And what is the scope of your management expert's work? Is it employed within the entity or a third party? Whether the management can exercise control over the management expert, and many other factors. And how much knowledge or experience you as an auditor have with respect to this factor. All of this affects the nature, timing, and extent of procedures which you are going to perform and evidence which you are going to obtain. So here the standard is very, very simple. If there is a management expert who has helped the management with a number, you have to understand three things. CUA. C stands for competence and capability. U stands for understanding the work of management expert. Then you will evaluate the appropriateness of the management expert's work. So over here, in case of management expert, you're going to get the evidence from management expert. So first, before that, understand their competence or capability. In our example, lawyer, right? Is he or she a lawyer? Do they have a bar council membership? All that you need to evaluate whether they are really capable and objective. Objective means uh, having your own judgment, right, and not being influenced by others. If these three criteria are met, okay, we are good to go to the next point. Try to understand, because it's in an they have expertise in a field other than accounting and auditing, so we are not experts in that scenario. You will have to try to understand how has he arrived at that provision, what are the basis, what are the assumptions. Try to understand. Once you're little bit familiar with the process, the next step is to understand the appropriateness of the work which is being performed by the management expert. So CUA, competence and capability, understanding the work and evaluating the appropriateness of the management expert's work. The next standard is SA 610. Mostly a lot of direct questions are only asked from SA 610, because earlier when I used to write my CA final exams, this was actually a CA final portion. It was as part of the final syllabus, but then as part of the new scheme, they moved it to the intermediate syllabus. So here they're talking about SA 610 using the work of internal auditors. So there are two ways in which I can use the work of internal auditors. How can I use, if I'm using, what am I supposed to do? In what scenarios I can't use internal auditors' work? All this in brief, we are going to understand this standard. So before even moving on to the standard, we need to know what an internal auditor does. What is their responsibility? Fine. Earlier, I was explaining about internal controls, right? So management didn't want the auditors to come and point out their misstatements. So they established something called as internal controls. Then what happened? Your Companies Act came and told that for certain limits, for certain companies, the auditor should also check the controls. So we as auditors, we have to check two things. One is the financial statements, and the next thing is also internal controls. So we are not finding faults with the financial statements, but also with respect to the internal controls. Now imagine from the management side how irritating it is, right? So after that, they brought in, or they wanted to bring in, or they wanted someone else to check the controls even before the auditor comes and checks. So a person who's specifically going to evaluate and check the internal controls is called as internal auditor. So what they do is, on a quarterly basis or on a half year basis, even before the auditor they come and check the controls. Why am I establishing control as a management? To reduce the possibility of misstatements. Now this guy is going to come and check the controls as well. Who? The auditor. So what the management did, they are going to appoint a person called as internal auditor who will come on a timely basis. They will check and test the internal controls. Now imagine from an auditor's point of view. As on 31st March, you're sitting. They've given you the financial statements. You have to see the financial statements as well as internal controls. Financial statements, normally you will check. Now internal controls, understand. See, already it has been tested by a person called as internal auditor. Every quarter he has checked. So standard is telling SA 16, see how beautifully they've drafted. See, there is already a person called as internal auditor who has tested. If you want, you can rely on his work. You need not duplicate it. You can rely on the work of an internal auditor. You can use the help of an internal auditor. So auditor can use the internal auditor in two ways, right? One is using the work of internal auditor. So the internal auditor will give you a report. You can use that report, and basis that you can see whether you need to decide to test any further controls or not, or you can just completely rely on the report alone. Or you can choose to use the direct assistance of the internal auditor. When I say direct assistance, what it means is, internal auditor would have already done their work. There will be a report. You've gone through that, but you feel that more work needs to be performed. I want to select more samples by myself. I want to, test more samples and see if the controls are operating properly or not. In this scenario, instead of you separately testing the controls, what you can do is, internal auditor has a good rapport with the management, because every quarterly once they'll go and visit and they'll be testing. They they've been doing it for so long, so they'll quickly finish it off. So what you can do is you can select the samples, but you can use the help of internal auditors' work. They will test it for you and give it to you, then you will review. That is what is called as direct assistance. So you can use the work of an internal auditor, or you can use the direct assistance of internal auditor. Both are totally different. Using the work is just relying on their report, whereas direct assistance means you are relying, but you're not really comfortable with just the report. So you want to independently select samples. And instead of you testing it, what the standard tells, you can make the internal auditors test it for you. So these are the two ways in which you can use the internal auditor. So whenever you're going to use the internal auditor, there are few things which you need to check, right? When you're going to use the internal auditor's help in any way, you need to see whether they are objective. You need to see whether they are competent, and you need to see whether they follow a very systematic and disciplined approach. If these three are not there, if any one is also not there, in that case, you cannot use the help in any way. You cannot rely on the report. You cannot use their direct assistance in any way. Objectivity, competence, and systematic approach. Right. Okay, fine. Now, let's say I'm going to choose option number 1, which is just going through their report or reading their report. How am I going to use? I'm going to use someone else's report. So I need to discuss with the internal auditor and tell him or her that, boss, I know you've prepared a report. I'm going to read that. Next one, I'm going to read the report and understand what are the procedures which is being performed by the internal auditor. Then I'll have to conclude saying whether, okay, whatever procedures is performed by the internal auditor, is it really sufficient or not? If it is yes, it stops over here. But if it is not sufficient, then only comes using the direct assistance of internal auditor. Here, prior to using their work, you'll have to actually enter into an agreement. And it should cover 2 aspects. See, the internal auditor must maintain confidentiality. It should not share any information which we are giving as auditors and share it with the management. And they have to follow the instructions of the auditor. So this is what will happen in case of direct assistance. And direct assistance is not possible if there is no objectivity, no competence, or it carries a lot of risk and there are a lot of judgments. In that scenario, see, there is a lot of judgment and risk. It's better if you independently test and you need not use the assistance of internal auditor. The next standard which we are going to be discussing is audit sampling. So audit sampling talks about how we are going to select samples, etc., etc. And is it really mandatory or not? So generally in audit, there are 2 different approaches. One is a traditional approach. The second approach is called as risk-based approach. In case of traditional approaches, you will be testing 100% of the population. But in case of risk-based approach, only then you will be selecting samples and testing. See, in a company like ITC or Reliance, there will be crores and crores of transactions every day. I cannot check the invoices of everything. I have to pick samples and I have to test the accounts based on samples. In that scenario, if you're following a risk-based approach, then SA 530 audit sampling becomes mandatory. Now, it is not mandatory. As I told you, only if you're following a risk-based approach, you need to follow standard SA 530. Right? Okay. The next one. Okay. Now, moving on to different terms which is being considered. I need to explain different terms before I move on to SA 530. Right. So the first term which you need to know is called as population. Population means nothing but the transaction listing or the journal entry listing of with respect to one specific account. That is what is called as population. Each transaction in that population is called as a sampling unit. The number of samples which you're going to select is called as sample size. The method which you're going to use to select each line item as your sample is called as sampling method. So with this, we are going to start off your sampling. So as part of the sampling process, it is covered across 7 different points. Let's understand each of them in detail. So the first step, if you're going to select samples, first step is sample design. First thing, you need to determine what audit procedure you're going to perform and for what population. Is it for revenue? Is it for expenses? Is it for bank accounts? Is it for assets, liabilities? So you'll have to decide. The next thing is you have to obtain the population and see whether the population is ARC, A, R, C. The population must be appropriate. Let's say you ask for the revenue listing. They need to give the revenue listing. It needs to be reliable and it needs to be complete, right? Whatever transaction listing total amount you're getting, that should match with the P&L presented as revenue, right? After that, you'll need to see if you need to stratify the data. Stratify means split it into different classification on certain basis. So first to determine the audit procedure, what account you need to obtain the population and see if it is ARC and see if it needs to be stratified. The next step is to determine the sample size. Okay, fine. Now I've obtained the population, right? And I've checked everything is appropriate, reliable, and complete and all that. What is the next step? I need to determine how many samples I need to pick from this population. Is it going to be 5? Is it going to be 10? Is it going to be 15? Is it going to be 100? You will have to decide. So there are two methods in which you can decide the sample size, which means the number of samples. Statistical approach and a non-statistical approach, which is called as a scientific approach and a non-scientific approach. So you can determine these numbers using scientific tools. So there are a lot of applications and tools which can help you in determining the sample size. Let's say for this value and this materiality and this risk, how much will be the samples which I need to take? Is it going to be 10, 15 or 20? That tool or application, that scientific tool will tell me a number. So let's say it tells 15. Then 15 will be your sample size. So that is called as a statistical approach. It is a more preferred approach because it is based on a lot of facts and it is based on science and statistics. Whereas a non-statistical approach is based on the auditor's prior experience and knowledge. You will determine. So it's based on one person's judgment, which is the auditor's judgment. It can be anything and changes from one person to another. So you'll have to decide what is going to be the number of samples and you have to decide how are you going to determine the sample size, whether it is based on a statistical approach or a non-statistical approach. And this number of samples is affected by certain factors. So for test of controls, there are certain factors, and for test of details, there are certain factors. When I say test of controls, it means that you as an auditor, I told you, right, you'll have to test controls. So which is what we are going to discuss now. So the first factor is actually auditor's risk assessment. Auditor's risk assessment means you would have assessed the risk for each of the account and control, right? So what is the risk? Is the risk more? If the risk is more, then you'll be needing more number of samples. And what is the tolerable rate of deviation? When I say deviation, it means that the control is not operating properly or not operating effectively. If there is a mistake in financial statements, I'm going to call it as a misstatement. If there is a problem or issue and people are not following the controls, it is called as deviation. So what is the tolerable rate of deviation? How much deviation can you tolerate as an auditor? If you can tolerate more risk, if you have a higher risk appetite, then your sample size will be lower. What is the expected rate of deviation? Are you expecting more deviations in the current year? If you're expecting more, then your sample size will also be more. And what is your desired level of assurance? Do you want to give high assurance? Then in that case, you will have to take more samples. Higher the risk, more number of samples. If you can tolerate more deviation, then lower samples. If you're expecting more deviations, then more samples. And if you want to give more level of assurance, in that case also, you'll have to select more samples. In case of test of details, where you're performing audit procedures for financial statements, ROMM means risk of material misstatements. If you're expecting the risk to be more in revenue, in that case, you'll have to select more samples. However, for revenue, this is not the only audit procedure. You're going to perform other procedures as well. Then it means that you need not select more samples over here. Why? Because anyways, you're going to perform other procedures, right? In that scenario, if you're going to perform other procedures as well, then the number of samples which you're going to take can be less. What is the desired level of assurance which you're trying to get through this? Is it more or less? If you're going to get more level of assurance, then more will be the number of samples. How many misstatements can you really tolerate? If I can tolerate more, I have a higher risk appetite, then I'll have to select less samples. If I'm expecting more misstatements, again more samples. And in case I'm going to stratify the data, when I say stratify, I told you, you're classifying or dividing the population based on certain characteristics. In that case, you just have to take one sample from each of the classification, because that one line item represents that entire subset. In that case also, my sample size or number of samples will reduce. So these are the different factors which affect the sample size. Next, okay, fine, you have decided the sample size as part of second step. Next what? Fine, let's say my population is 100, which means I have 100 different transactions, and sample size is 5, which means that I have to select 5 samples. Which line item or which 5 items need to be selected as sample? For that, I need to determine a sampling method. So as per SA 530, there are 5 different methods. First one is called as random selection. Second one is called as systematic selection or interval sampling. The next one is monetary unit sampling. The next one is haphazard sampling. And the next one is called as block selection. Right? Okay, first one. When I say random selection, it doesn't mean you randomly select samples. No. So there is something called as random number tables, right? It's a statistical table. If you're going to select sample using that random number table, that scenario, it means that you're following a random selection method. When I say systematic interval sampling, it means that you'll arrive at which line item needs to be selected as you'll arrive at an interval. How you need to arrive at the interval is your total population, number of units in population divided by the sample size. Let's say my population comprises of 100 line items. And let's say I have to select 10 samples. It means 100, or let's say in this example 50 line items are there, and I need to select 5 samples. Here I'm arriving at an interval of 10, which means that every 10th item I need to select as my sample. So you'll have the list, no? Every 10th item I'll be selecting as a sample. So based on this interval of 10, you will select the 10th transaction as your sample. When I say monetary unit sampling, it means selection of samples based on value, right? Highest 5, or let's say out of 100, 10 samples you're going to select. Top 10 transactions. So that if you're using that method, then it is called as monetary unit sampling. Haphazard means not following a structured way. Selecting samples on an unstructured way, randomly selecting. Random means not using random tables. Let me take the 5th line item. Let me take the 9th line item. I like number 19, or I like the number 12. Not using a structured way and just, selecting samples just like that is called as haphazard sampling. Block selection means selecting a block of contiguous line items. Contiguous means continuous line items. Let's say this is the list of transactions, and I'm selecting only continuous of all of these lines. Let's say there are 5 to 6 different lines. This entire block, I'm going to select it as my sample. That is what is called as block selection, right? So, okay, fine. I have selected the samples. Next, what? The next step is I need to perform the audit procedure, right? For the selected sample, whatever is the procedure, I need to perform the audit procedure. Then after that, understand the nature and cause of deviation or misstatements. Misstatements means mistakes in the financial statements. Deviation means the control is not being followed. So if identified any deviation or misstatement, you need to discuss it with the management and understand, boss, why has it happened? What is the reason for this deviation or misstatement? The next step, an important step, is projecting the misstatements, which means, let's say your total population value is 1000 rupees, right? And you have selected 100 rupee as your sample. Just selected one sample. Your total population value is 1000 rupees. In this 100, you noticed a misstatement of 10 rupees. And this 100 is a representative of 1000. The sample represents the population. In that 100 itself, there was a 10 rupee misstatement. I'm going to project this for 1000 rupees. If that is the scenario, then even at a 100 rupee value, there is a 10 rupee misstatement. If I project it, it's a simple ratio proportion. it means there will be 100 rupee misstatement in the 1000 rupees. So you'll try to project whatever misstatements you've identified to the untested population and say that out of 10 represents 1000. In that, 100 represents 1000. In that 100 itself, there is 10 rupees of misstatement. Then of the total population, so this is nothing but 10% is wrong, right? That is what they are trying to tell. 10% of the existing value is wrong. So then for 1000 rupees, the misstatement is going to be 100. Why we are projecting it is because I cannot test everything. You are going to test on a sample basis, and the sample you expect it to represent the entire population. So if there is a mistake in one part, we expect the misstatement to be in other parts as well. And if you feel that there are a lot of mistakes, and if you project the amount and it becomes too material, what you will ideally do is you will select more samples again and try to test and see if you are able to identify a pattern for all of these misstatements. Why are you projecting? Because you want to reduce your risk and you want to be really sure that the financial statements does not comprise of material misstatements. After projecting it, and for projection, for test of controls, projection is not applicable, because for test of controls, you're saying either they have followed the control or not, they have not followed the control. It is not an amount or quantity. It cannot be quantified. So in that scenario, you cannot project misstatements. Whereas with respect to TOD, you can really project the misstatement. But in case of anomaly, you are not going to project misstatements. When I say anomaly, it means nothing but a misstatement which is not representative of the entire population, which means it's a one-off error. If it's just a one-time error, you will not project it and all, because it happened only one time. It is not going to exist in the rest of the population. So for anomaly and test of controls, you are not going to project the misstatement. And finally, you will try to evaluate and arrive at a conclusion for that specific account. Right? So 7 steps. First, sample design. What procedure? Obtain the population, check if it is appropriate, reliable, complete. Then determine the sample size using statistical method or non-statistical method. Then you will have to select the samples using a sampling method. It can be using random number tables, or it can be used based on an interval, or it can be based on value, or it can be based on an unstructured technique, or it can be a block of continuous line items. After that, you perform the audit procedures. You see if there are any misstatements or deviation. You have to project the misstatements, and you have to finally evaluate and arrive at an audit conclusion. Now, quickly moving on to SA 501, which talks about audit evidence hyphen specific considerations for selected items. So they're telling we have to give special attention and specific consideration to 3 things: existence and the condition of inventory, completeness of litigations and claims involving the entity, presentation and disclosure of segmental information. So for these 3, they are asking us to perform separate audit procedures. Now let's move on to inventory first. So when they're telling, what they're telling in SA 501 is, when the inventory is material, the auditor should obtain SAAE for the existence and condition of inventory. Why specifically to existence assertion is because inventory at times it can be very small and risk of theft is very, very high, right? So that is why specifically they are trying to focus on existence of inventory. So here 2 things they are telling. First, we need to go and attend the physical verification being performed by the management. Let me make it very clear. They are not asking you as an auditor to perform the physical verification. They are asking the management to perform the physical verification. So you will have to go and attend, and you will have to perform audit procedures over the count results. While attending, they are asking you to do certain things. The catchword for that is EOIP. While attending, what are you supposed to do? So, for any physical verification you go, management will have certain instructions. You will have to go through the instructions. So, evaluate the management instructions. Second thing, okay, fine, you evaluated the instructions. Now what you need to do is just observe the account. And then you inspect the condition of the inventory. Look at the condition. Does it look rusty? Does it look old? Does it look obsolete? and you perform test count, because management is going to count it for you. To reconfirm certain numbers alone on a sample basis, you try to perform test count. So this is what EOIP you'll be doing at the time of attending the physical verification. Then once you're done with this observation process, so you will have records, right? So as per the inventory or books of accounts, the quantity will be 2, and let's say as per your count it might be 1. Then there is a difference. So this is as per your books, and this one is as per count. So you'll have to evaluate the results. Okay, as per books it's 2, but as per my count is only 1. What happened to the other? It's missing. Did someone steal it, or is it sold? And entry has not been taken for that specific sale. You'll have to try to evaluate your count results and arrive at a conclusion. That is what is called as the second procedure which you will be doing. And later part of the standard, what are they telling? You have to consider certain matters while attending the physical verification. So the catchword over here is Palti 1. So yeah, P stands for whether they maintain perpetual inventory system. When I say perpetual inventory system, so there are two systems, perpetual and periodic. Perpetual means updating the inventory on a real time basis. Periodic means after a week or after a month they are updating the inventory. Perpetual is much more better, because at a real time basis they'll try to capture the entries relating to inventory, and you have to evaluate whether you need an expert in case of performing the physical verification. See, certain inventories, no, it's not as easy as just counting 1, 2, 3. Let's say if it's in liquid form or if it is in gaseous form or all that, there are a lot of mathematical and scientific calculations involved. So in that scenario, you'll be needing the assistance of experts. How many locations are there? Because based on that, you need to send people to attend the physical verification. Again, ITC or Reliance, they have a lot of outlets, and banks, right? So you need to determine that. And the timing of the physical verification you need to plan. And what is the nature of internal controls they have? What is the stage of work in progress? And whether adequate instructions are being established by the management, risk of material misstatement, and the nature of inventory. All of these matters you need to consider when you're attending the physical verification, right? And yeah, the next one is, if you're as an auditor, if you're not able to attend the count, let's say management is going to perform the count on 1st April, and due to certain reasons, let's say you're getting married or you have your engagement or you're not well, you're not able to attend the physical verification, you have to ask them if it can be performed on an alternate date. If they don't agree, for an alternate date, you have to perform alternate procedures. If you have to see whether you can perform any other procedures, or if you're unable to do anything, you will have to modify your opinion. And in case inventory is not held in the company's warehouse, it is held at a third party location. So from the third party, you can ask them a confirmation. Third party, please can you confirm the quantity of inventory? And if they are not giving you the confirmation, what you can do is you can inspect any other documents, the purchase invoice and all that, or if you can ask if you can go and attend the physical verification at the third party warehouse. If they are not allowing us, you have to arrange another auditor to perform the physical verification at the third party location. Now moving on to the second part of the standard, which is talking about completeness of litigations and claims. So a lot of cases, and litigations means cases filed against the entity or for the entity. See, it's cases filed by the entity or filed against the entity. So in this scenario, generally all of these litigations and all that are off balance sheet items, and people don't give importance to this, and it results in huge amount of cash going out of the business, right? So it's a little bit risky. So they're asking us to perform certain procedures so you have to obtain SAAE, which means sufficient appropriate audit evidence to evaluate the completeness of litigations and claims. So what are they asking us to do over here? First, they're asking you to do a set of procedures. You inquire the management, and if they have an in-house lawyer or legal counsel, You ask them, boss, please tell me, you yourself tell me, what are the legal cases? Then additionally, what you'll do, you'll go through the minutes of the meetings and try to understand what are the lists of cases. So through inquiry, you'll have a list and you'll go through the minutes and see if you are able to get additional litigations. And then you have something called as legal expenses. See, if there is a litigation, there will be a lawyer. To them, you will be paying some money, which will be accounted as expenses. So try to go through the expenses and see if there are any new litigations and claims. First, you perform these three. You will obtain one set of data. In certain circumstances, you can ask the management. So let's say they don't have an internal legal counsel, they have an external lawyer, right? In that case, you can directly communicate to the external legal counsel or external lawyer through a general letter of inquiry and ask them, can you please, tell me what can be the cases against this company, right? That is the next step. First, through internal sources itself, you get information. Then what you do, okay, through this I'm not really satisfied, I want to reach out to the lawyer, so I'm sending a letter of inquiry. Hi sir, I am the auditor of so and so company, can you please send me the list of litigations filed by the entity and against the entity? If it is going to be just a general letter of inquiry, you're just going to leave an open-ended question, you're not going to keep it very specific. But if you feel that a lawyer or an external legal counsel is not going to respond, you can send a specific letter of inquiry. When I say specific letter of inquiry, you're going to specify and ask directly what are the list of litigations and claims, what is the management's assessment, are they going to win, in their opinion, are they going to win the case or are they going to lose the case? As per the legal counsel's opinion, are they going to win the case or are they going to lose the case? You can send them a specific letter asking for these three details instead of sending a general letter of inquiry. Now you need to understand, from internal source you have one set of data, and through external source, through your general letter or specific letter, you have one set of data. Just you're communicating to these lawyers only through letters. Now, in certain circumstances, you can directly meet and talk with the lawyer, have an in-person meeting with them. That when will you do is only in, again, three circumstances. If it carries significant risk, which means high risk, the matter is too complex, or there is a disagreement between the management and the entity's legal counsel. In these scenarios, you can directly meet and talk with the legal counsel. Significant risk, matter is complex, and there is a disagreement between the management and legal counsel. In these scenarios, you can directly meet the legal counsel, and you can modify your opinion if the management is not letting you talk with the legal counsel, or the external legal counsel is not giving you information, or in any way are not able to obtain any information or evidence. In that case, you can express a modified opinion. Now, quickly moving on to segmental information. This talks mostly about presentation and disclosure of segmental information. You'll have to try to understand what are the methods used by the management to present the revenue or profit or whatever it is of each segment, and see whether it is as per AFRF, and see if you can perform certain analytical procedures. Now, moving on to external confirmation. Right. External confirmation means nothing but obtaining a direct written response from a third party in paper or electronic form. Right. There are two types of confirmations. One is called as positive confirmation request and negative confirmation request. Usually, auditors use positive confirmation request. Negative confirmation request is actually used only if certain conditions are satisfied. When I say positive confirmation request, it means that you're sending a request, you're asking a party to confirm certain balances, and they'll have to respond whether they agree or disagree with whatever information you're given in the letter. But when I say negative confirmation, the party will respond only if they disagree to whatever information you've given. Let's say you're saying that the debtor balance from you with respect to this customer is 100 rupees. In case of positive, they'll respond any which way. Even if they agree or disagree, they'll say, yes, I agree. Or they'll respond saying, no, I disagree. It's actually 80 rupees, whatever it is. But in case of negative confirmation request, in simple terms, it means silence amounts to acceptance. if I'm not even going to get any response from the third party, it means that the balance is correct. So this is actually really risky, because I am sending, a confirmation request to a bank or a debtor, and they can simply ignore. We ignore a lot of messages, we ignore a lot of mails. Simply, they can also ignore. So negative confirmation is a little bit risky. So here, the auditor must have control over certain aspects. First one, you need to determine what information you're going to request, and you have to determine which parties or to which third parties you're going to send this request. Then you have to design this request, and then you have to send the request. It is not enough only if you send the request, you'll have to also follow up with them. Right. Okay. The factors which you need to consider while designing the confirmation request. So the catchword is lame CAM. L stands for the layout and presentation. A stands for the assertion which is going to be considered. M stands for the risk of material misstatement. E stands for the prior experience. C stands for method of communication. Are you going to send it through courier, or is it going to be through mail? And A stands for ability of the third party to confirm. See, only if they have the capability of understanding and confirming, only then you will be sending the confirmation request. And then M stands for the management authorization letter. See, immediately if you send a mail asking for confirmation to a third party, they'll get scared. So you'll have to attach a management authorization letter. In a management authorization letter, what will be there is, boss, our auditors are reaching out to you as part of their audit procedures. Can you please help them in getting evidence and just confirm to the request? That is what will be there in your management authorization letter. So as I told you, negative confirmations is not used in all circumstances. It is used only if all of these 4 conditions are satisfied. What are those 4 conditions? The risk of material misstatement needs to be very, very low. And the population must comprise of large number of small homogeneous items. When I say large, it talks about the volume. When I say small, it means the value. With respect to value, it's very small. And population, the number of line items, let it be how much ever it wants. And it has a very low exception rate. Exception rate means nothing but the difference between balance as per books and the balance confirmed by the third party. That is what is called as an exception rate. Usually there is, if there is no a lot of differences identified in this confirmation, in that case you can send a negative confirmation. The last point, auditor is not aware of any circumstances that the third party is going to disregard your request. What they're trying to tell is, for sure that, let's say I want to send a negative confirmation to a third party. For sure that the third party is not going to ignore my request. They'll definitely see and they'll respond. If you know that for sure, only then you can send a negative confirmation. So only if these 4 conditions are satisfied, you can send a negative confirmation. Low exception rate, low risk of material misstatements, large number of small homogeneous items, and you're not aware of any circumstances that the third party is going to ignore your request. And in case management is not letting you send the confirmation, ask them why are they not letting us send. Understand what is going to be the risk and see if you can perform alternate audit procedures. Fine. The next one is SA 510, initial audit engagements - opening balances. Here, initial audit engagement means an engagement for which the FS is there, no FS of the prior period. It was either not at all audited or it was audited by a predecessor auditor. Basically, you'll have the comparatives, right? Either you would have not audited last year. It wouldn't have been audited, or it would have been audited by a predecessor auditor. So here what they are telling is, you have to perform procedures for opening balances. Why? Because last year it was audited by someone else or it was not at all audited. And the opening balance has an impact on my current year closing balance. When I say opening balance, it means opening balance of balance sheet accounts. So the opening balance is carried forward, no? Then there will be movements. Then you will arrive at the closing balance. So let's say your cash balance is there, right? Let's say opening balance you had 10,000 and during the year, let's say you have spent 100 rupees, which means your closing balance is 9,900. See, this 100 rupees is the transactions which happened during the year. For this, you will perform procedures. But what if the mistake is there at opening balance? What if there is a mistake because last year you didn't audit it. Either it was not at all audited or it was audited by some other auditor. See, in case of P&L, it is only during the year. But for balance sheet, it is asset balance. So it has an opening balance impact. That is why they are asking us to specifically perform audit procedures for opening balances. Right. And they're telling only in initial audit engagements, which means last year someone audited or no one audited the opening balances. Okay, fine. Now, what procedures you need to perform? Determine whether the previous year closing balance has been brought forward, which means in ledger, you have by to balance carried down or by balance carried down, whether it has been brought down appropriately, right? And determine whether whatever accounting policies is reflected for opening balance, that is what is reflected for the closing balances. So here the accounting balances must be consistent and you'll have to perform the following procedures. You have to go through, peruse the previous year financial statements and audit report if it is audited. Go through the financial statements and go through the audit report and see if you can perform common procedures for opening balance as well as closing balance, and see if you need to perform separate or specific audit procedures just for this opening balances, right? Based on this, you will have to arrive at an audit opinion. Now, the next standard is SA 550, which talks about related party. So, related party definition, what they are telling first, for related party, see, whatever is the AFRF, you take the definition as per AFRF. When I say AFRF, it can be Companies Act, it can be Income Tax Act, it can be your accounting standards, anything. But if in AFRF there is no definition for related party, then you can use the following definition. When a person or an entity has control or significant influence over the entity which you're auditing, where someone is trying to control directly or indirectly or has significant influence over the entity which you're auditing, or the entity which you're auditing controls or has a significant influence over the another entity, or if two entities are under common control, that case all of these companies or entities are called as related parties. See, in first scenario, reporting entity is being controlled. Second scenario, the reporting entity is controlling. In the third scenario, the reporting entity and another entity are under common control, siblings. So that sibling becomes your related party. So here they are not only saying control, they are talking about also significant influence. When I say control, I am the one taking the decisions completely. When I say significant influence, I am just participating, but I am not the final decision maker. I can give my opinion, it will be valued, but it will not be the final decision. Over here, what they are trying to say is, in case of related party transactions, the risk is very, very high. When related party transaction enter into a transaction, no, risk of fraud is very high, because since all of them are closely related, it can be a fictitious transaction and all of them will lie for one another. They'll not reveal the truth because they all are closely related, right? In that case, risk is very, very high. Why they carry high risk? Because sometimes the transaction might be very, very complex, or the information systems, whatever they are using, it might be ineffective. And it is generally for related party transactions, it is not as per normal market terms. Basically, let's say if you're selling a good, let's say you're having a shop and you're selling something. Let's say the normal rate is 100 rupees, but for your friend, will you sell it at 100 rupees? No, you'll sell it at a lower rate. Let's say for your mother or father or relatives, you'll sell it at a lower rate, which is not actually right. Doesn't happen as per your normal market terms. So because of all of these three risks, they are asking us to perform certain audit procedures. What are they telling? You first understand how the management tries to identify the related parties and understand what is the nature of the relationship. Is it a holding, subsidiary, associate? Try to understand the relationship and see if they have actually entered into any related party transaction. So as per accounting standards or Ind AS, all these three needs to be disclosed. What are the list of related parties? What is the nature of relationship which I am having with the related party, and what are the transactions entered with the related party? Right? Fine. Here, they are also asking us to evaluate the controls over the related party transactions. For example, any related party transaction needs to be approved by the CFO, CEO and director. That is a control. You need to see whether all of these controls are operating properly or not. And then what are they asking us to do? They're asking us to go through certain documents to understand the related party transactions. See the income tax returns and see if any related party transactions are disclosed. See if any information is submitted to any regulatory authorities, or see the shareholders register and try to understand if you can get any information. Go through contracts, different see if any renegotiation has happened. Go through the internal audit report to see if there are any highlights with respect to related party transactions. So all this you'll have to understand for related parties. The next standard, I believe, is SA 520, which is the last standard forming part of your chapter number 4. So SA 520, which talks about analytical procedures. What is analytical procedures? So here, so similar to sampling. In sampling, we had 7 steps. In analytical procedures, we just have 4 steps. So first, let's look at the definition, and I'm going to try to explain 2 examples. Through those 2 examples, you'll try to understand, or you'll be able to understand what analytical procedures as such mean. Now, analytical procedures, the definition, it means evaluating the financial information. How are you evaluating them? By analyzing the relationship between financial and non-financial data. It also encompasses, means it also includes investigating the identified fluctuation or the relationship that are inconsistent with other relevant information. What are they trying to see? Okay, you have a financial information in your hand, you're trying to evaluate it. How are you trying to evaluate? First, you'll establish a relationship between financial data and non-financial data. And you'll try to investigate the identified fluctuations or unusual transactions. This is what is called as analytical procedures. So, actually, there are 4 different types of analytical procedures. One is called as trend analysis. The next one is called as ratio analysis. The next one is called as reasonableness test. And the other one is called as structured modeling. When you're trying to compare 1 year data with another, that is what is called as trend analysis. Not necessarily year, 1 period data with another. That is called as trend analysis. When you're trying to compare 2 ratios, let's say your gross profit ratio for current year and previous year, right? Your gross profit ratio in the current year is 40%. And last year, let's say it was 50%, right? When I say analytical procedures, you're trying to see the ratios, trying to compare the 2 years ratio. Last year it was 50, current year it is 40. So there is a fluctuation, there is a decrease of 10. Right? Why is a decrease? You have to investigate and understand. This is what is actually called as analytical procedure. So 4 types of analytical procedures: trend analysis, ratio analysis, reasonableness test, and structured modeling. Right? Now I have 2 examples over here. Let's say the revenue is 20 lakhs. And for whatever revenue you earn, you need to collect the GST from the customers and pay it to the government. Let's say the GST collected on this is around 3 lakhs. And let's say I have an expectation. Let's say they're selling specific good or service and the GST rate is 18%. That is my expectation. Right? If it is 18%, then what will be the GST? Your expectation, 2 lakhs into 18%. So you expect the GST to be 3,60,000. But in the financial statements, it is only 3 lakhs. Then you have identified a difference, or it is called as a fluctuation. See, you're not going at a transaction level and saying, okay, invoice, what is the rate? How much they have paid? At a transaction level, you're not trying to do. Overall, you're trying to analyze. So here, I expect it to be 18%. So I expect the GST to be 3,60,000, but it's actually only 3 lakhs. So there is a fluctuation of 60,000 rupees. So over here, you have so as per books, financial records, there is something. But as per your expectation, you have something. There is a difference. You're trying to arrive at a reasonable amount. See, reasonably, as per my expectation, it is supposed to be 3,60,000. But what it is actually 3 lakhs. So the fluctuation is 60,000 rupees. So this is an example of a reasonableness test. We just now discussed, no, reasonableness test. I'm trying to assess the reasonability of the GST liability. Revenue is this much, which is the financial data. GST is also the financial data. I'm trying to form a relationship between financial information and non-financial information. The financial information is revenue. Non-financial information is the GST rate. That is not going to form part of your financial statements. So I'm trying to establish a relationship and I'm trying to develop an expectation. What is the expectation? 3,60,000. What is the fluctuation over here? 60,000. So I'll have to investigate this fluctuation, understand the reason. See, it doesn't mean that it is a misstatement. Why? Because overall, you're just trying to analyze. This is not a misstatement. It is just called as a fluctuation, which means you have doubt. There is something unusual. You will discuss with the management and try to understand the reasons for this difference. So this is one simple example which I wanted to explain. So you're trying to evaluate a financial information. What are you trying to evaluate? The financial information relating to GST. How are you going to evaluate? By establishing a relationship between financial information and non-financial information. The financial information is revenue and the non-financial information is your GST rate. You're trying to establish a relationship, which is revenue into GST rate. Right, you apply and you develop an expectation, which is 3,60,000 rupees. That you compare it with the actual and see if there are any differences, which is called as fluctuations. If there are any fluctuations, you'll try to investigate, talk with the management and try to understand the reasons for the same. So that is on analytical procedures. Usually this analytical procedures, it's performed during planning, substantive and conclusion phase of audit. However, over here, in this standard, this covers only the analytical procedures performed during the substantive and conclusion phase of audit. See, what is the main purpose of, performing? You need to see if there are any unusual transactions or any fluctuations or anything which indicates higher risk so that you can select more samples. Right? We discussed 4 examples: trend analysis, comparing 1 year data with another; ratio analysis, comparing one ratio with another; reasonableness test, you try to arrive at a reasonable amount, form an expectation and compare it with the actual and see what is the fluctuation. Structured modeling is something which is done using statistical tools. Right. Now, what are the steps? First, you need to determine what type of, when I say SAP, it means not your SAP system, that accounting system. It means substantive analytical procedure, which means I'm performing this analytical procedure as part of my substantive phase. So for that, there are 4 steps. Determine what type of analytical procedure I'm going to use. Am I going to compare different period data, or whether I'm going to do ratio analysis, or whether it's going to be reasonable test, or am I going to use a statistical tool? I need to decide that. Then I have decided that what procedure I'm going to, what type of analytical procedure I'm going to perform. The next thing, I need to obtain the data, both financial as well as non-financial data. I need to obtain the revenue data and I need to obtain the GST rate. And I need to determine whether I can rely on it or not, whether I can trust it or not. It depends on the source, nature and circumstance in which it is obtained. Then after that, I'll develop an expectation, which is 3,60,000 rupees, and see if it is whether sufficiently precise. Almost close. I cannot say it's correct. It's just an estimate, right? And then after that, I need to investigate the fluctuations, investigate the results. It's actually 3 lakhs, but it was whatever I've expected is 3,60,000. So the fluctuation is 60,000. I need to investigate and discuss it further with the management. So this is what is overall covered as part of chapter 4, another very, very important standard. Another important chapter where you can expect 4 to 5 questions for around 15 to 20 marks. So the next chapter which we are going to be discussing is actually chapter 6, audit documentation. So we have around 1 question over here, and mostly, the questions is being asked from ownership of audit documentation, or what is the time limit to compile all of the audit files, or with respect to retention of audit documentation. These are the different types of questions. When I take that, I'll specifically point out that these are the questions which is being asked. So here the standard which is being discussed is SA 230. The name of the standard is audit documentation. Audit documentation is nothing but a record of the procedures performed, the evidence obtained, and the conclusions reached. So any auditor, whatever you do, you have to document everything. So there's a general statement which will be made by all of the chartered accountants. So work not documented is work not done. So let's say you would have done something, but you don't have a retention in the form of documentation. People will assume that you didn't really do that work because they don't trust you that much, right? So you'll have to have a record of all of the procedures you performed, all of the evidence which you obtain, and all of the conclusions. So whatever you need, whatever you do, you'll have to document it and keep it as a record. That is what is called as audit documentation. For each of the client, everything compiled together for each engagement, the compilation of everything is called as an audit file, right? What is the objective? You need to have a record of all of the documentation just to prove that yes, I have a proper basis to arrive at the audit opinion. That is the main reason as to why you document everything. So the purpose of audit documentation, let's understand. So the catchword for this is PADRIC. So P, it helps the engagement team to actually plan the audit. So let's say if you've already documented and kept it in the previous year, next year you come, so you already have the prior year documentation. It helps you in planning, right? A stands for accountability. So if everything is documented and it is assigned to one specific person, and that person is the one who prepared it, then if you have a retention of that, it means that you can hold that specific person as accountable. And it also helps you direct and supervise the work, because whatever work is being done by the article assistants, only if it is documented, another person can supervise or review, right? R stands for having records for future audits. For future audits, definitely it's going to help you. I stands for inspection by other regulatory authorities. In case people are going to come and inspect, you should have those files so that you can give it to them. And Q stands for quality control. So I is for external inspection, Q is for internal inspection. So as part of your internal quality controls, monitoring, I told you, no? So they will come and review our files as part of SQC1. So your audit documentation, what is the form, content, and extent of audit documentation? You should prepare your audit documentation in such a way that anybody who goes through will be able to understand the following. What are the nature, timing, and extent of audit procedures performed? What are the conclusions or your results of audit procedures? Were there any significant conclusions, significant risks, or significant judgments which was taken as part of your audit? So while documenting this, you'll have to clearly identify the characteristics of specific matters of testing. You'll have to also tell who performed the work, on what date the work was complete, and who reviewed the work and who completed. Only if you tag all of this to each of the documents, then only you can hold that person as accountable. Next, with respect to significant or important matters, you need to be very, very careful, and you need to document, okay, this carries high risk. You need to tell why it carries high risk. What are the judgments which were made from the management point of view or the auditor's point of view? Why do you think that it was difficult? What are the evidence which you obtain, and what are the different conclusions which you have reached? So you have to clearly explain it in such a way that any normal human being should be in a position to understand. And any information which you have discussed with the management or those charged with governance, all of those should also be maintained as part of your documentation. The next part is timely preparation of audit documentation. So here you need to understand that any audit documentation you take. So let's say one person is auditing all of the P&L items, the other person is going to audit the balance sheet items. Or let's say in an audit team, let's say you're auditing ITC or Reliance, the audit team is not one or two members, it's hundreds and hundreds of people. A lot of people will be working on such engagement. So once you're done with the opinion, it doesn't mean everything is over. See, the documents and all will be with different people. Each one, whatever work they've performed in their laptops, they'll have the file. But it's the auditor's responsibility to collate and collect all of those files and save it in one place. So This is called as audit compilation, right? So timely preparation, what they're trying to say is you have to timely prepare audit documentation. So whenever you finish your work, you document it on that basis. And you have to assemble the audit file. I told you, right? Audit file means all of the audit documentation relating to one engagement is called as an audit file. So even though I've given the opinion, different people will have the evidence and information, everything in their own respective systems. The standard is being very correct. They're telling that they're going to give us 60 days time to compile everything. So I, as the auditor, I need to compile everything within 60 days from the date of audit report. And this 60 days, let me be very, very careful over here. You all have to be careful. This is mentioned as per SQC1. 60 days time limit is given for compilation of the final audit file. And in the 60 days from the date of audit report till the 60th day, you cannot make any changes to the files which you have, because your work is already done and based on that only you have given the opinion. So no changes as such can be made at all, but only the following changes can be made. Again, this can be a potential 4-mark question. The 60 days is as per SQC1. I'm repeating again. This is the time limit for giving assembly of the final audit file as per SQC1. But however, the following changes can be made. If you can delete or discard any repeated or superseded documentation. You're just trying to sort and collate and give certain cross references. Or if you're, signing off certain completion checklist. Or you're documenting an audit evidence, but it was obtained, discussed and agreed even before the audit reporting. So basically, you obtain the evidence, you discuss this with your partner or your auditor, and it was all agreed upon. But the only thing is you didn't document it. That scenario also you can do it within the 60 days time limit. So all of these 4 things can be done after the date of audit report, but it must be completed within 60 days. Discarding or deleting any unwanted or repeated information, sorting and collating everything, signing off on checklists, and documenting any evidence which is already obtained, discussed, and agreed with the auditor before the audit report date. And the last part is retention. Okay, fine, I've compiled it within 60 days and I have it. Now, for how long should I retain? I need to retain it for a minimum period of 7 years from the date of audit report or group audit report, whichever is later. And this is also given as per SQC1. They're saying no shorter than, which means minimum 7 years, maximum how many ever years you want. So be very, very careful. Minimum 7 years from the date of audit report or the group audit report date, whichever is later. And this is given as per SQC1. Right? So 60 days, 7 years, right? 60 days for compilation of the final audit file. That final audit file, I need to retain it for a minimum period of 7 years. And there is a small topic called as completion memorandum. When I say completion memorandum, it means nothing but a summary of all of the important things which happened as part of your audit. Any significant matters or how are they addressed. A summary of all of this is called as completion memorandum. Usually, all of the high risk areas, any significant matters, if you document and keep it as a summary, it will be easier for the next year because you need not go through the entire audit file to identify what are the issues and risks involved. The next thing is ownership. Again, here also SQC1, even though we are talking about SA 230, a lot of places we have SQC1 coming into the picture. So SQC1, what they tell is audit documentation is the property of the auditor only. So when I say audit documentation, it is the ownership, complete ownership is with the auditor. However, the auditor can share portions or extracts, small portions or extracts. They can share it to the clients if such sharing does not undermine the validity of the work and does not affect their independence. You can share it with the client, not the complete file, but extracts of it. If it is not going to, if let's say you share and the client is going to question your validity of work and tell you what work have you performed, or if they're going to question your independence, in that case you cannot share. But if they're not going to do such things, in that scenario you can share. The ownership is again the auditor. However, you can share it with them only if they're not going to undermine the work which you have performed or they are not going to question your independence. Only in these if both of the circumstances are satisfied, you can share. 60 days, minimum period of 7 years you need to retain, and ownership is with the auditor. All this are mentioned as per SQC1. Right, this is a very small standard. Again, questions. Yeah, I told you questions, right? So questions where they will ask is assembly of audit file, the 60 days time limit, and what all changes can be made after the audit report date. Retention period, this can be asked as an MCQ, and also with respect to ownership and whether he can share information or not. This can be asked as questions for 4 marks, 4 to 5 marks, right? So that was on chapter number 6. So now we're going to start off with chapter 7, which talks about completion and review. So actually I told you, right, we have 3 phases in audit: planning, substantive and conclusion. So chapters 1, 2 and 3, all of them were relating to the planning phase of audit. And then chapter 4 is relating to the substantive phase of audit, and 6 is with respect to conclusion. Now, the chapter 7 is a transition from your substantive or execution phase to the conclusion phase, ideally forming part of the execution phase of audit. So here we have a couple of standards: SA 560, 570, 580, 450, 260 and 265. These 6 standards are something which we're going to discuss. Again, 2 questions are being asked from this chapter. It can be either 4, 5, around 8 to 10 marks is the weightage for the specific chapter, right? The first standard is subsequent events. So here, how are they defining subsequent event? So there are 3 parts to this definition. First part, from the events which occur from the date of financial statements till the date of audit report, and facts that come known to the auditor after the date of audit report but before the FS is being issued. Then the third part is facts which come known to the auditor after the date of audit report. So let us understand what each of this means. So let's say the financial statements date is going to be 31st of March 2020. We are in 2026, right? So 2026. So, and let's say your audit report date is going to be 15th August 2026. But let's say you're preparing the audit report and you're signing it on 15, but you'll not immediately give. Let's say you want to wait, and let's say September 1st is a good day. 2026 is the date on which you issue the FS. When I say issue the FS, it means that the FS is available to third parties and the stakeholders. So any events which happen between these 2 dates, from the date of financial statements till the date of audit report, that is the first category. Second one, which comes after the audit report date, basically after 15th, but before the FS is being made available to the third party. So it means from 16th till 1st of September. That is the second category. Anything which you come to know after 1st September, that is the third category, where you come to know about the facts after the FS has been issued. Facts or information or events as to what? So basically, any facts or circumstances which can be considered as an adjusting or non-adjusting event. When I say adjusting event, which means that had you known, or this condition existed as at the balance sheet date, but you got to know today. Had you known it before, you would have adjusted the 31st March financial statements. That is what is called as adjusting events. But non-adjusting events means it does not really affect the financial statements, but you have to disclose it, right? So adjusting and non-adjusting events is what is being talked as facts over here. If you come to know during your course of audit, or after the audit report date, or after the FS is being made available to third parties, you come to know about facts. But ideally, it should have been adjusted, or there should be a specific disclosure. But this didn't happen. In these scenarios, how will you approach as an auditor? This is what we are going to discuss as part of SA 360. So what are the procedures which you'll perform in 3 circumstances? 1, if you come to know about the events from the date of financial statements till date of audit report. See, that is not risky, because if you identify anything, you can very well go and ask the management to correct it. But if it is after the audit report date, even in that case, it's okay, because the FS is not being made available to the third party. But if it's in the third case, it's fatal. So let us see how the auditor will react in these 3 circumstances. So we're going to split the standard into 3. The first part, any events which you come to know from the date of financial statements till the date of audit report. What are they telling you? First, you talk with the management. See, anything you take first step, it starts with inquiry with the management. You start from the source. You talk with the management and understand how they identify subsequent events, and ask them, in this year, are there any subsequent events which you are aware of? You go through the minutes of the meetings and see, after minutes of the meetings which has happened after the date of financial statements, and understand if any event is going to affect my current year financial statements. See if they have prepared any interim financial statements, and ask the management or TCWG to make adjustments with respect to the adjusting events identified. So these are the procedures: by inquiry, by reading the minutes, by reading the interim financial statements. Through this, you will get to know whether there exists subsequent events or not. If it exists, it can be either adjusting or non-adjusting events. Accordingly, ask the management to make the changes in financial statements. So this is on first scenario. You obtain information. If they need to make a change, you ask them to change. That's all. That is the first category. Second category talks about any events or facts which you get to know after the date of audit report. As in, the financial statement is finalized. You have prepared the audit report, and the only thing is you have not issued it or made it available to third party. It's with you only. So in that scenario, what you have to do? So we are going to discuss the procedures. See, ideally, you don't have any obligation to perform separate set of procedures after you finish the audit report. But however, if you come to know about a fact, about a subsequent event, had you known this earlier, it would have resulted in an adjustment or a disclosure. In that scenario, if you come to know by any chance, what are they asking you to do? You discuss it with the management. Go and talk to the management and those charged with governance, and tell them that this has happened, and ask them whether they are going to make this respective change in the financial statements or not. How are they going to address this matter? So they can address it in two ways. One, they can completely ignore, or they can make the amendment in financial statements. So if they agree to make the amendment, in that scenario, what you need to do is you have to extend your audit procedures to your new audit report date. Understand what is the subsequent event which has happened, obtain evidence, and see what adjustment needs to be made. You have to go through the amended financial statements, and you need to extend your audit procedures with respect to only that subsequent event. And over here, you actually have two options. Either you can give a new audit report, right? In the new audit report, so you can provide a new audit report. That is the first option which is available. Or what you can do is, in the existing audit, see, you've already prepared an audit report, right? In an existing audit report, you can have an additional date. The initial date would have been 15th August. Let's say now you come to know some event, let's say on 30th August, right? Second scenario we're discussing, 30th August. So you can have two dates. The audit report can be dated with the original date and the latest date. And you can say in the existing audit report itself that the additional date you have added because you have identified a subsequent event and you have performed certain audit procedures, and the FS has been accordingly amended. So in the existing audit report itself, you can make minute changes to include this specific change, or you can issue a new audit report. See, all this will happen if the management is going to completely change the financial statements. But if the management is not going to change the financial statements, what you can do is you can give a new audit report, or in the existing audit report itself, you can say that you're going to express an audit, a modified opinion, right? If they're not going to amend it, then the financial statements is wrong, right? So you can express an modified opinion. The third scenario, which is the fatal one, where here you have issued the audit report and it has gone to the third parties. In that scenario, again, you don't have any separate obligation as such to perform any audit procedures. But however, if you come to know, in that scenario, again, the same set of procedures. Discuss with the management and those charged with governance. Ask them how they are going to address the situation, and see if they are going to amend the financial statements. Ask them if they are going to amend the financial statements. In this case, if they are going to amend the financial statements, again, the same set of procedures. You need to carry out audit procedures for that specific amendment. And see, they've given the old financial statements and also the old audit report. You need to see what are the steps taken by the management to recover or to get back the previous financial statements and audit report, right? And you have to give a new audit report. And in that new audit report, you need to clearly state that, boss, already there was an old financial statements and old audit report, and you've also got it. But I'm issuing a new audit report. See, one financial statements cannot have two audit reports in most circumstances. So here you have to give a separate paragraph, which is called as emphasis of matter paragraph. The meaning of this, which we'll discuss in chapter 8. You need to emphasize specifically saying that I issued an old audit report, but please don't rely on that. You rely on this new audit report. I'm issuing this new audit report because a change happened. I knew it only at this date. So you please rely on the new audit report and the amended financial statements. So here you're telling them to ignore the old set and to rely on the new set. So here you will just have to give a new audit report. But however, if the management is not ready to amend, see, it's a very cumbersome, tiresome task. They'll not want to amend because they've already given. In that scenario, generally the management should take steps to inform the shareholders and third party in saying that this amendment or this adjustment has not been taken in the financial statement, so please don't rely on it. Generally, management is supposed to take. But if the management is not taking, you just request them and tell them, please can you take the steps to tell them that this change has not been made. If they don't do that, you yourself will have to save your selves and take steps to inform the third party saying that there is a subsequent event which happened. Management was not willing to take the amendment, so please don't rely on my audit report. So that is the third scenario. 3 scenarios, 3 sets of procedures. Now moving on to SA 570, which talks about going concern. So over here, going concern, we all know it is one of the basic principles which we follow as part of accounting. Going concern means what? You expect a company to continue its business for a company, an entity to continue its business for the foreseeable future. So over here, with respect to going concern, as an auditor, what are your responsibilities? So what are they trying to tell? So let's say you set an alarm, or let's say I ask you the question, how many years are you going to live? People will say 20 years, 30 years. So you have a going concern for yourself. You expect yourself to live for that long. It's a positive mindset. Similarly, for business also, accounting principles told us to have a positive mindset. And it told us that you'll have to have the assumption that the business is going to continue for a foreseeable future, right? If you feel that the company has going concern, they'll follow going concern assumption and prepare the financial statements. However, if you think that the business is going to shut down within the next 12 months or within the next year, in that case, they have to prepare it on liquidation basis. The problem over here is management always, they blindly follow going concern and prepare financial statements. But there will be circumstances where the company or the entity is doing horribly wrong and it's going to liquidate. Even in that scenario, they'll prepare based on going concern, but actually they should have prepared on liquidation basis. For you to have this check on the management, that is why we have this separate standard called as SA 570. So here, you actually have 2 things to do. First thing is, so there are certain responsibilities which you need to fulfill. First one, you need to obtain sufficient appropriate audit evidence regarding the appropriateness of the management's use of going concern assumption in preparation of financial statements. So if the management has prepared the financial statements using going concern assumption, you need to evaluate whether is it rightfully used, is it appropriate or not, whether they're supposed to use going concern or should it be prepared on liquidation basis. Second point, let's say going concern they should follow, but you're taking a next step further. Are there any small indications which is called as material uncertainty relating to going concern? To conclude whether there exists a material uncertainty which affects the entity's ability to continue as a going concern. See, you're not concluding that it doesn't have going concern, but there are certain conditions which indicate that there is some uncertainty with respect to the going concern. In that scenario, you just have to ask the management to make disclosures. Let's say a lot of employees are leaving, they're losing a little bit of their customers. In that case, all of them are red flags. So you have to follow conservative principle or prudence principle and make a disclosure, right, from finance angle. So you as an auditor have to see, okay, going concern as such, fine, it's fine, but there are small uncertainties which might affect the going concern. So you're taking another step further and see if there is a material uncertainty relating to going concern. And these responsibilities include even if the AFRF doesn't ask the management to perform a going concern assessment. So if the reporting framework doesn't ask the management to perform a going concern assessment, you have to request the management or force the management to perform such assessments. Right? Okay. And in case there are there is absence of material uncertainty relating to going concern, it means that you're not going to report anything, but it does not mean that it provides a guarantee that the entity is going to continue for the foreseeable future. So actually two responsibilities. One, assess the going concern. See whether it is really going to continue or not. If it is going to continue, then you have to see whether there are small uncertainties which might affect the going concern. Right? Okay. So here what are they trying to tell? First thing, as part of going concern, management would have made an assessment, right? First part is assessing the management's appropriateness of use of going concern assumption, right? First, see, whatever assessment they are making, no, it needs to cover a period of 12 months. That is mandatory. It's given as per SA 570. If it is not, if the management assessment is not covered, it is not covered a period of 12 months, you ask them to cover. Ask them if they made an assessment. If not, beg them and tell them, please make the assessment. And see if they have made the assessment, for what period it's done. If it is less than 12 months, you need to extend the assessment to cover a period of 12 months. If it is 12 months, well and good. Then you have received the assessment, right? Go through the assessment. Understand what are the future plans. What are the future plans which they have for the business. Check whether it is really feasible or possible or not. And see what are the cash flow statements prepared by the management. What are the assumptions which is being used for the cash flow projections. See if there are any additional facts to support the management's going concern assessment. You have to obtain a specific written representation from the management regarding going concern. Then discuss the cash flow with the management. Go through the interim financial statements to see if you can assess the entity's ability to continue as a going concern. And see if any terms of debentures or loans are breached. Because if you are going to breach any terms with respect to borrowings or debentures, then it is payable on demand. You'll have to pay crores and crores of money, which may result in shutdown of business, right? You go through the minutes of the meetings, discuss if any legal cases are there or not, and see if they have any other plans to, deal with unfilled customer orders, which basically means there are certain customer orders, but they've not completed the customer orders. And with respect to subsequent events, have you identified any issues? And are there any disposal of assets which is being planned? So through all of these procedures, you will be in a position to assess whether the management's use of going concern is appropriate or not. With all of this, first base, you obtain information from the management, their assessment. To support their assessment, see the customer orders, see asset sales, see terms and conditions of borrowings, through minutes of meetings, subsequent events. See, there are a lot of points given. Your questions are going to be for 4 marks or 5 marks. So the least expectation is around 4 or 5 points. Try to remember whatever possible and try to bring it out. So these are the procedures which you actually perform to see whether use of going concern assumption is appropriate or not by the management. So that is on the first part of the standard. Very simple. The second part is, okay, going concern assumption is appropriate, but is there any events which cast a doubt on the going concern? Is it going to affect? Is the going concern really uncertain? That you need to assess. So there are certain indications which might affect the going concern. Again, it's all uncertain. You're not saying with certainty, right? So what are those conditions? There are 3 types of conditions: financial, operating, and other indicators. Financial indicators, let's say they're in a net liability position. Their liabilities are more than the assets. There are a lot of borrowings without any prospects of repayment or renewal. There are A lot of creditors were supporting financially, now they're withdrawing. Your operating cash flows are cash losses. There are a lot of arrears with respect to dividends. You're not paying dividends properly, you're not able to pay the creditors, you're not able to fulfill the loan commitments or borrowings commitment. The creditors change from your suppliers, basically your vendors. Earlier you used to buy on credit basis, but now they're making you buy on cash basis, cash on delivery, because they're not relying on you, they're not ready to give you credit, they want you to pay immediately. And inability to obtain borrowings, all these are financial indicators which say that there might be an indication that your going concern might get affected in the future. Again, it's all might and uncertain. What are the operating indicators? Managements are having certain discussions to liquidate, or let's say they have lost few of the key managerial personnel, or they lost a major market or customers, or they lost their licenses. There are a lot of labor difficulties, a lot of people or laborers are leaving, important supplies they're unable to get. And let's say there is a highly successful competitor which came in, for example Airtel, Vodafone, Idea, in telecommunication industry. They were the ones. When Geo came in, it became a threat for all of these people, which resulted in a material uncertainty relating to going concern. Doesn't mean that Airtel's business was shutting down. Just casted a significant doubt on the entity's ability to continue as a going concern. In that scenario, you should have disclosed that there is a major competitor. They lost a lot of customers, but we are trying our best to recover. The next one is other indicators. If let's say they have not complied with any capital or other statutory requirements, or there is any legal proceedings pending against the entity, there are certain changes in laws and regulations, or any uninsured catastrophes have happened. Catastrophes means disasters, basically. Let's say a fire accident or floods or earthquakes have happened and you've lost your factory. All these are indications that there exists a material uncertainty relating to going concern. If see through your audits, it's not like you need to specifically look at if these conditions exist or not. As part of your audit, if you feel that any of these boxes are ticked, in that scenario you need to request the management and ask them to make a specific disclosure. Right now we are going to assess how our audit opinion is going to be in following circumstances. Management has used going concern, but it is actually inappropriate. They are going to actually liquidate, but still they have followed going concern assumption. In this scenario, you shall express a modified opinion. However, going concern assumption is inappropriate only, but a material uncertainty exists. I told you if a material uncertainty exists, it means that you have to make a disclosure. Fine, adequate disclosure is being made for that material uncertainty. In that case, you shall express an unmodified opinion, and separately this should be disclosed in the financial statement. So you will have a specific paragraph in your audit report under the heading material uncertainty relating to going concern, and you will say that, boss, go through this note as part of your financial statements. There is a material uncertainty relating to going concern. It has been already disclosed in the financial statements. However, I am not modifying the opinion. Why? Because the issue as well as the solution for that issue will be disclosed by the management. Right? Again, here I am repeating, opinion as such you are not going to modify. Opinion is unmodified, but additionally you are going to bring in a paragraph which is called as material uncertainty relating to going concern. There you are going to highlight that a disclosure is being made in the financial statements. Open your eyes and look at that. Next, if adequate disclosure is not made, in that case you can express a modified opinion. If management is unwilling to even make this going concern assessment, in that case also you can express a modified opinion. The next standard is SA 450, evaluating misstatements identified during audit. Misstatements in general, I told you, it's nothing but mistakes in financial statements, right? So here, what do you need to do as an auditor if you identify misstatements? See, a very small and simple standard. If the misstatement is very, very trivial is again a threshold. Let's say it can be 100 rupees or 1 rupee or 10 rupees. That's all. It's called as clearly trivial. You will completely ignore, right? Anything other than trivial. So any misstatements which you identify during the course of audit, you have to split it into two. Individually material, or it is approaching your materiality, or it is individually immaterial. What you need to do is anything which is individually material, then and there, you need to see if you need to revise your strategy or plan. You need to see how this is going to affect your audit procedures and samples. I told you, right, if you identify misstatements and if your risks become high, then you have to select more samples. See how is it going to affect your further audit procedures. Then you have identified a mistake, no, and it is material and it is closer to materiality. That scenario, go and communicate this to the management and ask them to correct it immediately. See, misstatements you identify, but the rectification as such needs to be done by the management. If it is material or closer to the materiality, immediately the correction needs to happen. But however, individually it is immaterial, you start accumulating it. And then towards the end of audit, when you're arriving at the audit conclusions, at an aggregate level, if it is material, ask the management to correct all of the misstatements, because put together it is exceeding your materiality. But the aggregate as a whole, if it is immaterial, just communicate that you have identified these misstatements and in aggregate it is immaterial, and ask a confirmation from the management. Again, individually immaterial, aggregate level, if it is material, you have to ask the management to correct it. But on an aggregate level, if it is immaterial, you just inform the management and obtain a written representation. And let's say whether individual or an aggregate basis, it is material, but the management is not willing to correct it. In that case, you can express a modified opinion, and you'll have to communicate all this to the management as well as those charged with governance. Right, your audit documentation, it should include any misstatements which should be regarded as trivial, basically the trivial threshold, whether whatever accumulated misstatements, whether it is corrected or not, and what is going to be the effect of uncorrected misstatements, whether it is immaterial or not. Now moving on to SA 580, written representations. So here in written representation, what is written representation? Written representation means nothing but a written statement obtained from the management and provided to the auditor confirming certain matters to support the audit. So any information which you obtain from the management, so I'm the auditor, if I obtain any information, usually through inquiry procedures you get information, but the issue is at time of inquiry they'll say something. The next day if you ask the same thing, same questions, they'll give you a different answer. There is always a risk. So here standards, what they're telling is any information which you get from the management, orally, you please get it in writing from them. So they'll have to, what they will do generally towards the end of the audit, whatever information they gave you orally, they'll have to write it down and give it as a confirmation saying that all of this I only provided you. That is what is called as written representation. Why? Because this is to save yourselves. Let's say in any investigation or court or police investigation or anything, or ICI is inspecting or NFRA is inspecting, and they ask you as an auditor, to the auditor, what is this? This is wrong. This is incorrect. Then you can point out saying that, no, the management only told me. Management, if it was an oral form of evidence, then the management would told, no, I didn't tell you. There is no proof for you. But then through the standard, you can say, no, I have a written representation. Management clearly made this statement and they have signed this written representation. So it is a document prepared by the management which comprises of all of the information provided by them during the course of audit. So this is just to save yourselves. So written representation is very, very necessary, but it does not provide sufficient appropriate audit evidence. See, it is some level of evidence, but that alone does not provide. I need to perform additional audit procedures because management is telling something. I am obtaining in writing. Fine, no problem, but I need to confirm it. For that, I need to perform other audit procedures. So what are the objectives? You need to obtain written representation from the management that they have fulfilled all of their responsibilities with respect to preparation and presentation of financial statements. It actually supports our audit and it provides audit evidence, but not sufficient appropriate audit evidence. And to respond if the management is not providing any written representation. So in a written representation, what are the things which needs to be included? I, the management, is responsible for preparation of financial statements. I am responsible for whatever information is given to the auditor. So, whatever information you have obtained during the course of audit, all of that can be brought in the written representation. Next, a declaration that all of the transaction has been recorded and it has been reflected in the financial statements. You can ask them to describe what are their responsibilities in general. And if any other written representations which has been specified by other standards on auditing, for example, subsequent events, I told you, right, you need to obtain written representation. For misstatements, SA 450, just now we discussed, for that you need to obtain a written representation. All that you can include in this one letter. And you have to obtain a written representation that the selection and application of accounting policies are appropriate. And the following whatever is the following matters, they have been recognized and measured as per the AFRF. Whatever plans or intentions which may affect the carrying value of assets and liabilities. Liabilities are, all of them are disclosed, be it actual or contingent. All of the title or control over the assets are in the name of the entity, and all of the laws, regulations, and contractual arrangements and agreements have been followed. And in case of any deficiencies means deviations in internal controls, for all of that also the management needs to provide a written representation. And in addition to all of this, if there is anything specific which you want the management to confirm, you can ask them to write it in this written representation. Now, when should they prepare this letter and for what period? So your audit starts immediately after 31st of March and goes on till, let me take the same example, 15th August. So you need to obtain the written representation closer to or on the date of audit report, because till the date of audit report, you'll be continuously getting information from them. So on the date of audit report or closer to that, whatever they gave you orally, you need to obtain it as a declaration and get it signed. And it must be in documentary form. However, okay, the form of written representation, it needs to be in the form of a letter. But in certain circumstances, you need not obtain written representation. Let's say if any information or declaration is made by the management and it is available in the public domain. Let's say they made a statement in a news channel, or let's say it come in a newspaper. In that scenario, you need not obtain separate written statement. Why? Because it's already available in the public domain. They've already given a confirmation. For that specific areas, you need not obtain written representation. Next, if you have doubts on the reliability or the integrity of the management, see, management is going to give you information, they are going to write a letter and give it to you. Anyone can write and sign, but you don't really trust them. In that scenario, you have to assess whether you can rely on this written representation or not. But if you feel that you cannot rely on this, you can go ahead and express an unmodified opinion. That is what they are trying to tell over here. If you are unable to rely on whatever the management is going to tell, if you're not able to trust them, you can go ahead, discuss with them and evaluate whether they are really they follow integrity and honesty or not. If you feel that no, then in that case you can express a modified opinion. And okay, let's say they have already given written representation during the audit, but you can reconfirm the responsibilities through the written representation in the following circumstances. If the ones who have signed the audit letter, the engagement letter, is no longer in the organization, so you're reconfirming their responsibilities again in the written representation. Certain responsibilities are known. When can you reconfirm certain things? When engagement letter was signed by the CFO, but now in the written representation, another CFO is going to sign. But he can say, I am not responsible for all that because I didn't sign the engagement letter. That risk can happen. So they're asking to repeat all of the responsibilities from the engagement letter. Again, cut, copy, paste to your written representation so that the new CFO can also assume the responsibilities. Or let's say the engagement letter was prepared in the previous year. Current year, there is no engagement letter, no? So you bring all of the responsibilities again in the written representation. Or let's say the management is confused about its responsibility. Let's not take any risk. Let's bring the management responsibility and reconfirm it. Or let's say in any other circumstance, you feel that you have to reconfirm the responsibilities. In that scenario, you can bring it over here. Now, So this is what is there as part of written representations. Moving on to SA 260, which talks about matters to be communicated with a person called as those charged with governance. So what does those charged with governance actually mean? Those charged with governance means a person who is responsible for the strategic direction of the business and who's also responsible for overlooking the financial statements process or financial reporting process. Why is this standard actually that they want to actually develop a proper and effective two-way communication between the auditor and those charged with governance. They want to have a proper working relationship, and also so that auditor can obtain information from those charged with governance, and those charged with governance can also receive information from the auditor or tips or advice from the auditor, so that they can reduce the risk of material misstatement. So to have a two-way communication. Now, there are 4 matters which we mandatorily need to communicate with those charged with governance. Can I communicate anything other than whatever are disclosed over here? Yes, absolutely, you can communicate other matters as well. So, mandatorily, what and all you need to communicate? First one, auditor's responsibility with respect to financial statements. This is my responsibilities. I am responsible for only forming and expressing an opinion. However, this does not relieve you from your responsibilities. And what is the scope and timing of audit? See, this is my scope and this is the timing within which I'm going to complete my audit. You need to communicate that as well to this group of people called as those charged with governance. The next thing, any significant findings which you identify as part of your audit. When you say significant findings, it means any qualitative aspects which you have about the accounting policies. Do you feel that you need to change any accounting policies, any important changes which you need to bring? Those changes you can communicate. And any difficulties which you face, let's say you're not able to obtain evidence from the management, those are one example of significant difficulties. Any significant or important matters which you need to discuss with those charged with governance. Important matters means, let's say it's resulting in a material misstatement, obtaining written representation, and circumstance which affect the form and content of audit report. Form and content means, let's say you're expressing a modified opinion, or let's say you're including a paragraph relating to material uncertainty relating to going concern, or any other matters which is going to affect the responsibility of TCWG. All these can be communicated with those charged with governance. The last one is with respect to independence. In case of listed entities, mandatory, see, in all scenarios, you need to communicate those charged with governance saying that you are independent. But in case of listed entities, you need to clearly state that in a written form. You need to communicate saying that you are independent. How do you usually communicate? It can be in oral form or written form. However, with respect to your generally oral form is fine, but it's always communicate everything through written form, right? But independence alone, mandatory, it needs to be in written form. And when should you actually communicate? Whenever you want, on a timely basis, it is better if you communicate with those charged with governance. And you have to evaluate whether this two-way communication is helping both of you. And whatever has been communicated orally or in written form, everything needs to be documented and compiled and needs to be kept as part of audit documentation. Now, moving on to the last standard, which talks about SA 265. See, SA 260, 265 and SA 450, they're actually, as part of old syllabus, it wasn't final, but they've moved on to intermediate. So don't worry much. Mostly it will be direct questions only. SA 265, communicating deficiencies in internal control. I told you deficiencies, deviations, both mean one and the same. It means that if the control is not being followed or if it is not operating effectively, in that case, it is called as a deficiency. So if you identify any deficiencies, you need to communicate it with 2 people. First, those charged with governance and also the management. So what is the objective? The main objective is ensuring that you communicate the deficiencies which you identify in the internal control to those charged with governance and the management on a timely basis. So let us understand. So there are 2 things which we need to understand before moving ahead into the standard. First one is deficiency in internal control. The next one is significant deficiency in internal control. See, it's similar to that of misstatement and material misstatement, right? Okay, what is a deficiency? Which means that a control is designed and implemented, but it is unable to prevent, detect. It is not serving its purpose. It's unable to prevent, detect, or correct misstatements on a timely basis. There is a control. It is implemented, but it's not serving its purpose. In that case, it is called as a deficiency. Or a control itself is missing. There is no control. First scenario, there is control, but it's not serving its purpose. Second scenario, there is a risk. There are a lot of issues, but there is no control. There is a gap over there. These two are the scenarios where a deficiency as such exists. Right. Significant deficiency. It means that the likelihood and the magnitude results in a material misstatement. Likelihood means the number of occurrences more, or even if the number of occurrences less, the magnitude or the value of that would result in a material misstatement. Because this control is not followed, this would result in a material misstatement. Such deficiency is called as significant deficiencies. So there are certain examples of significant deficiencies which is given. Right? So first I told you, likelihood of this leading to a material misstatement. Let's say because a control is not being followed, it is going to result in fraud. Or let's say there are a lot of judgments or complexity or estimates involved. Or the entire the FS as a whole is exposed to the deficiency. In that case, all of the numbers are going to be incorrect. Or the volume of transactions which is exposed to this deficiency is very, very high. Let's say for 1 crore transactions, there is a specific control, but it is not working properly. In that case, the volume is high, so that it is going to result in a deficiency. Or let's say there is a very important process as part of preparation of financial statements, and in that specific important process, there is a control deficiency. It is going to result in deficiency. Significant deficiency. Cause and frequency of deficiency. If this deviation or deficiency is repeated again and again and again on a daily basis, then definitely it is a significant deficiency. Or one deficiency is having a ripple effect on other controls. If you don't follow one control, it results in other controls not being followed. Because of this might lead to a material misstatement, which results in a significant deficiency. These are the different examples. What are the indicators, right? If they are not assessing the risks properly, management is not having a proper control environment, they are not overlooking the process, and nothing is being done properly. All these are generally, or management is not capable enough to oversee the financial statements process. All these are indicators of significant deficiency. Right now we have understood deficiency, significant deficiency. So deficiency means control is there, but it's not fulfilling its purpose. Significant deficiency means it is a deficiency and it is going to result in material misstatements. Frauds, deficiency in an important process, one deficiency having a ripple effect on other deficiencies. All these examples we discussed, right? So, okay, fine, there is a deficiency or significant deficiency. What am I supposed to do with that as an auditor? See, first thing is, if you've identified a significant deficiency in internal control, immediately report it in writing to those charged with governance. And then the next is report it to the management. And other deficiencies, it is enough if you just report it to the management. See, those charged with governance are the top guys. Below that, you have the management. First, significant deficiency, immediately report it to those charged with governance. Then you communicate it to the management. With respect to other deficiencies, it's all small deficiencies, right? It is not going to result in a material misstatement as such. So in that scenario, you can just report it to the management. In that communication, whatever you're going to, significant deficiency or other deficiencies, whatever you're going to disclose it with those charged with governance or management, you have to clearly explain the description of the deficiency and explain the potential effect. What is the issue and what is going to be the potential impact of this deficiency in the financial statements? And you need to give enough information so that the people understand what is the issue and what is going to be the impact. you need to explain that the purpose was to express an opinion on the financial statements, and this also includes you need to see the aspects of internal controls, and the matters are being, so whatever deficiencies you have identified, it is based on your own professional judgment. So these are the standards which is being covered as part of chapter 7. Again, 2 questions, a 4 or 5 mark question will be asked as part of chapter 7. So the next chapter which we are going to discuss is chapter 8, audit report. Again, you can expect 2 questions over here for 4 or 5 marks. So close to around 10 marks is the weightage for this chapter. So here we have, so this is the conclusion stage of audit, where we talk about audit report, audit opinion, what are the different contents of audit report, what and all in addition to whatever is there in standards on auditing as per Companies Act, you need to include as part of the audit report, is what we are going to discuss. So the first standard which we will be discussing is SA 700, which talks about forming an opinion and reporting on financial statements. So how do you form your opinion, with what basis, and how are you going to report that opinion, or how are you going to report the financial statements? So we know the objective of audit. SA 200, in SA 200 we discussed, first one, to obtain reasonable assurance that the financial statements as a whole are free from material misstatements which can be due to fraud or error, and thereby express an audit opinion. Second one is to express that opinion in an audit report, which means to report on the financial statements. So how will you form an opinion? First, you need to determine whether you have obtained sufficient appropriate audit evidence, and whether whatever uncorrected misstatements are there are individually or in aggregate immaterial. Only in that case you will express an unmodified opinion. Again, I repeat, you'll express an unmodified opinion, a good opinion, if you have obtained sufficient appropriate audit evidence and you're able to conclude that the financial statements as a whole are free from material misstatements. And how will you form this opinion? So basically, first, for each of the financial statements at an assertion level, you need to obtain sufficient appropriate audit evidence. Then for each account, you'll have to arrive at audit conclusion. Then finally is going to be your audit opinion. With the sufficient appropriate audit evidence only, you'll be expressing an audit opinion. There are 2 types of audit opinion: unmodified opinion and modified opinion. Unmodified opinion is as per SA 700 and modified opinion is as per SA 7 as per SA 705. Again, you will express an unmodified opinion only if you are able to obtain sufficient appropriate audit evidence and you are able to conclude that the financial statements as a whole are free from material misstatements. Right. So that is on the audit opinion part. Now, specific evaluations you need to make as an auditor. What are those? In addition to, your opinion, you need to make certain specific evaluations. First, whether all of the important accounting policies are disclosed in the financial statements. Accounting policies, whether they are consistent and whether they are appropriate. Whatever estimates the management have made, are they reasonable or not? Whatever information is actually presented in the financial statements, is it really relevant? Can I rely on it? Can I compare it? And can I understand it? What are the terminologies used in the financial statements? Is it appropriate or not? And whether the financial statements provide adequate disclosures. You need to evaluate all this in addition to forming your audit opinion. Now, let's quickly discuss what are going to be the contents of your audit report. So, the contents includes the following. First one, title. The title is going to be Independent Auditor's Report, and it is going to be addressed to the persons who actually appointed us. Let's say in case of sole proprietorship, it's going to be addressed to the owner of that business. In case of partnership, it's going to be addressed to the partners. Also in LLPs, to the partners. In case of companies, it is going to be addressed to the members, which means the shareholders. Your opinion paragraph. Right, the next is opinion. So in opinion, there will be 2 paragraphs. One is a general introduction paragraph and then actual opinion paragraph. So in different scenarios, the paragraphs is going to change depending on the type of opinion. That I will slowly discuss as part of SA 705. Now, they're saying general paragraph, first paragraph, there should be a general paragraph, and it needs to consider points relating to EAT-ND. EAT-ND is the catchword. You should specify the name of the entity which is being audited, state that it has actually been audited, which E stands for name of the entity, A stands for state that it is audited, T stands for title of each statement included in financial statements. Title of each statement means nothing but your P&L, balance sheet, cash flow, statement of changes in equity, notes to accounts. All this is called as title of each statement. You need to say that these are the things which is included in the financial statements, and you have to tell the you have to also refer it specifically to the notes to accounts, and also specify the period for which the financial statements is prepared, the date or period. So E stands for name of the entity, state that it has been audited, title of each statement included in financial statements, refer to the notes to accounts, and also the date or period covered as part of the financial statements. So if you take an audit report, how it will be is, we have audited the financial statements of the entity ABC Private Limited, which has been prepared for the period ending 31st of March, where the financial statements include statement of profit and loss, balance sheet, statement of changes in equity, statement of cash flows, and also the notes to accounts. In this general paragraph, all of these points needs to be covered. The second paragraph is going to be the actual opinion, whether they are expressing an unmodified opinion or modified opinion. The next one is basis of opinion. On basis of opinion, you need to say SRIA. S stands for state that the audit is conducted in accordance with standards on auditing, and you have fulfilled all of their responsibilities throughout this audit. You have remained independent throughout this audit, and you have obtained sufficient appropriate audit evidence. So, in basis of opinion, on what basis did you arrive at your opinion? I have followed the standards, boss. I fulfilled my responsibility. I've remained independent, and I've obtained sufficient appropriate audit evidence. With these four things as my base, I have formed my audit opinion. The next one, I told you, right? Material uncertainty relating to going concern. In case there is a material uncertainty and management has made adequate disclosure, you'll express an unmodified opinion and disclose it as part of going concern paragraph. Key audit matters and any other information, right? Key audit matters we'll discuss slowly as part of SA 701. Responsibility of the management. What are the responsibilities? They have to prepare and present the financial statements. They have to implement and operate the internal control. Going concern, management assessment of the going concern is also their responsibility. So these three you need to specifically bring in the financial statements. With respect to auditor's responsibility, there are a lot. What are the objectives of an auditor? State that reasonable assurance is the highest form of assurance, and clearly state that misstatements can be due to fraud or error. And you have exercised your own judgment as part of this audit, and you have used materiality to identify misstatements, and your responsibility is to identify risk of material misstatement, understand the internal control system, evaluate the appropriateness of accounting policies, and understand management's use of going concern. And overall, you need to evaluate the presentation structure and content of financial statements. So these are your general responsibilities. Any other reporting responsibilities? Your signature, place, date, and UDIN. UDIN is nothing but a unique identification number which we actually generate from the ICAI portal. So these are the contents of the engagement letter. See, if they have to ask a question from, they are not going to, sorry, not engagement letter, audit report. So this is the content of an audit report. These are the contents. These points needs to be mandatory included. They are not going to ask you to draft an entire audit report. They are definitely not going to ask. But questions can be from opinion, basis of opinion, and also with respect to responsibilities of management or auditor. These are the four areas where they actually test it separately. Opinion, basis of opinion, management and auditor's responsibility. See, opinion, EAT and D. Basis of opinion, SRI and A. Right. Moving on to the next standard, which is SA 705. Modifications to the opinion in the independent auditor's report. So basically a modified opinion, it's issued as per SA 705. When will you express a modified opinion? So generally, in two circumstances, when you are unable to obtain sufficient appropriate audit evidence, or you have identified misstatements in the financial statements and they are material and management is not willing to correct them, in that scenario, you as an auditor, you'll express a modified opinion. Right? Again, two scenarios: unable to obtain SAE, and there are misstatements in the financial statements which are material and management has not corrected it. In that case, you shall express a modified opinion. Again, in modified opinion, there are three types of modified opinion: qualified, adverse, and disclaimer. It is bad, worse, worst. Right? Qualified, adverse, and disclaimer. Qualified, when will you express? It's a type of modified opinion. Whether you have obtained two scenarios. You have obtained enough evidence and you're able to conclude that the misstatement is material, but it is not pervasive. By pervasive, it means that the misstatements, not only one, multiple misstatements, whatever misstatements you've identified, it does not affect the entire or almost all parts of financial statements. That is what is called as pervasive. With the evidence which you have, you're able to conclude that the misstatement is material but not pervasive. In that scenario, you'll express a qualified opinion. The second one is you're not able to obtain sufficient appropriate audit evidence. See, it doesn't mean that you have no evidence. You have some evidence. With that, you're able to conclude that the misstatements are material but not pervasive. In these two circumstances, you will express a qualified opinion. Next one is adverse. You have enough evidence to prove that the misstatements are material and pervasive. In that scenario, you'll express an adverse opinion. Disclaimer opinion. Disclaimer of opinion is a horrible opinion which can be expressed by an auditor. Here, you're unable to obtain SAE, but with whatever information you have, you're able to conclude that the potential impact, what would have been, the potential impact of this misstatements would be material and pervasive. In that scenario, you'll express a disclaimer of opinion. So, in each type of opinion, how is the opinion paragraph going to look like? So, that's all. This is what is there in SA 705, just the three different types of modified opinion. Now, in each opinion, be it unmodified, see, unmodified means SA 700, modified means SA 705. Again, in modified, qualified, adverse, disclaimer. Qualified meaning you have obtained SAE or you have not obtained SAE, but you're able to conclude that the misstatements are material but not pervasive. Adverse, now you've obtained SAE and you're able to conclude that the misstatements are material and pervasive. In case of disclaimer, you don't have enough evidence to prove, but you can say that the misstatements are material and pervasive, or the possible effects could be material and pervasive. Right? How is the opinion paragraph going to look like? In case of unmodified opinion, first EAT-ND. You have audited the financial statements of this private limited for the period ending. It includes the notes to accounts, P&L, blah, 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 blah. Second paragraph. In our opinion, to the best of our information and explanation provided to us, the aforesaid financial statements presents a true and fair view, which means that it is free from material misstatements. This is how a paragraph will look in case of unmodified opinion. In case of qualified opinion, how it will look is EAT-ND. We have audited the financial statements, blah, 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 blah. Second paragraph, modified opinion, qualified opinion, right? In our opinion, and to the best of information and explanation provided to us, the aforesaid financial statements gives a true and fair view, except for the issues noted in so and so accounts. So you have noted issues with respect to only one or two accounts. For that, you cannot say that the entire financial statements is not true and fair. So you're saying everything is okay except for this, right? Other than this, everything appears to be true and fair. That is what you're trying to say in qualified opinion. Now in adverse, second paragraph. In our opinion, and to the best of information and explanation provided to us, the aforesaid financial statements does not give a true and fair view, because you have enough evidence to tell that. Third scenario. In our opinion, and to the best of information and explanation provided to us, we were unable to obtain sufficient appropriate audit evidence, but in our judgment and opinion, we feel that the potential impact is material and pervasive. However, we don't have enough evidence. Hence, we do not express an opinion. So actually, you're not giving an opinion in case of disclaimer of opinion. And for that, people are paying you money. So it's not that easy to express a disclaimer of opinion, because management will never agree, because they are paying you lakhs and crores to do this audit. And in the end, you're saying that I don't have enough evidence, but you feel that it's going to be material pervasive. So I'm not going to express an opinion. You cannot express an opinion over here, because you're saying that the impact is going to be very huge, but you don't have enough evidence to prove it. So you're just saying this is what you feel, but you're not going to express an opinion. So that is how. So in disclaimer, you'll just say that we do not express an opinion on the financial statements. Right, moving on to SA 706, which talks about emphasis of matter paragraph and other matter paragraph. This emphasis of matter paragraph you would have discussed in subsequent events. So in emphasis of matter paragraph, what is being discussed over here? So emphasis of matter paragraph is communication, which is, okay, it refers, okay, so the definition is, so there are two things which we need to discuss: emphasis of matter paragraph, emphasis of matter and other matters. These two are separate paragraphs in your audit report. Emphasis of matter meaning what? This refers to matters which is already presented and disclosed in the financial statements, but you feel that it is that important, which is fundamental to the user's understanding of the financial statements. I repeat, you're talking about a matter where in your audit report, but the matter has been already appropriately discussed and disclosed in the financial statements. Why are you talking about it again? Because you feel that it is very, very fundamental and important to the user's understanding of the financial statements. See, our auditing standards have understood these students and humans mentality. Your financial statements of big companies, the annual reports, if you take, it goes on for 200 pages, whereas your audit report, it's hardly for 10 pages. And what are they asking the auditors to do? You summarize all of the important matters fundamental to the user's understanding, very, very important matters which happened in the entity, in your emphasis of matter paragraph. So you're giving a summary of the important matters in the audit report itself. So it's already there in the FS, but no one is going to go through 200 pages. So it's okay, in your audit report, you bring in, try to highlight it, try to re-emphasize it, bring the attention of the users of the financial statements to these specific matters. See, it is not necessarily issues as such, it's just important matters. Let's say a merger or an acquisition which happened. All these are important matters, but you want to draw the attention. It is very fundamental and important for the users' understanding. You're just trying to repeat it again in the audit report. That is what is called as emphasis of matter. See, it is definitely not a substitute for modification of opinion. See, you're just trying to highlight certain things which happened in the company. It's not a substitute for modification. It's not a substitute for key audit matters. What is key audit matters? Slowly in the next standard we'll discuss, and it is not a substitute for material uncertainty relating to going concern. Right. In case of emphasis of matter paragraph, what will you do? It will be a separate paragraph in your audit report, and you will clearly state that this matter has been already disclosed in the FS, but you as an auditor, you want to emphasize it because it is fundamental for the users to understand it. And you are saying that this has nothing to do with the opinion, you're just trying to highlight an important matter in the audit report. What are the examples of this emphasis of matter? Okay. First one, example, any uncertainty with respect to outcome of a litigation or a regulatory action. Let's say there is a case going on, or there is a notice given by any regulatory authority. There is a lot of uncertainty with respect to that. So that is an example of emphasis of matter. Or let's say there is any subsequent event or a significant subsequent event, or let's say there is a new accounting standard which is being issued, but you want to adopt it on a voluntary basis, early adoption, and a major catastrophe, basically a flood or any natural calamities. All these are examples of emphasis of matter. This would have been already disclosed in the financial statements. You're just trying to highlight it or re-emphasize it in the audit report. Right. The next one is other matters. Other matters means nothing but matters which is other than those which is being presented and disclosed in the financial statement. So it's not about matters which is being presented in the financial statement. It is about audit, auditor's responsibility and audit report. You're giving more details about audit, auditor's responsibility and audit report so that the users understand these three aspects. So other matters means matters which helps the users to understand audit, auditor's responsibility and audit report. So this emphasis of matter example, I will slowly discuss as part of branch audit. Right, just give me some time. Now, Essay 701. I told you I'll explain key audit matters, right? So we are going to discuss what key audit matters as such means. Let's just put a pause on other matters. Now, key audit matters, what does it mean? So, based on the professional judgment of the auditors, certain matters would have been really significant and important with respect to the audit. Such matters are called as key audit matters. Any matters which were significant during the course of audit based on the auditor's professional judgment, that is what is called as key audit matters. What are they trying to say? And they are trying to say that these matters may or may not be presented in the financial statements. Is there any difference between emphasis of matter and key audit matter? Definitely. So when I say key audit matters, it means that when they say significance, it means that importance, the amount of importance which you gave for that specific matter, or in other words, the amount of efforts which you put to obtain sufficient appropriate audit evidence. So let's say to obtain audit evidence for relating to revenue, or let's say relating to provision, you put in a lot of efforts. So you can emphasize in the audit report and say that shareholders, please, I've already done whatever possible to obtain SAAE. If you have any questions, please don't ask me, because I've clearly disclosed everything as part of key audit matters. I'm clearly saying that that was very important to me, very significant for me. I've put in a lot of efforts to obtain SAAE. Again, see, this is not a substitute for modification. You have obtained SAAE, but the thing is, you're just trying to point out that you have put in a lot of effort. Why do we have to bring in something called as key audit matters? See, it enhances the communicative value. You're trying to bring in additional details. You're trying to explain how much efforts and time you've spent. And it provides additional information, and it also helps the people to understand important areas. And also, it provides a basis for you to talk with those charged with governance. So, what areas are called as key audit matters? If it has high risk, if there are a lot of judgments and it pertains to significant transaction or events, those are called as key audit matters. So, when you're communicating a key audit matter, how is it going to look in an audit report? It is a separate paragraph in your audit report, and you have to define what is a key audit matter. You need to say that based on the auditor's judgment, you feel that certain matters were significant. What does significant mean? You have put in a lot of efforts, and you have to say that you are not providing a separate opinion for this. You're just trying to highlight that these were the important things which you saw. Now, moving on to the next standard, which talks about comparative information hyphen corresponding figures and comparative financial statements. What is this? There are three words over here: comparative information, corresponding figures, and comparative financial statements. Let's not go through the explanation or the definition. You will get confused even more. So when I say comparative information, it means nothing but the prior period numbers. That is what is called as comparative information. It can be in two forms: corresponding figures or comparative financial statements. Again, the prior year numbers can be presented in two ways: one as corresponding figures or one as comparative financial statements. The way of presentation depends on the AFRF. So what does corresponding figure means? Let's say I have current year numbers over here, and let's say I have previous year numbers over here. If I present current year numbers and the previous year numbers in a columnar format, this is what is called as corresponding figures. If I present the prior year numbers adjacent to the current year numbers as a corresponding figure, it is called as corresponding figures. Whereas comparative financial statements, in that scenario, how it will look is, you'll have current year P&L only. You'll not have any columns, right? And then you'll have current year balance sheet, current year cash flow, current year notes. That is one set. Attached to that, below, you will have the comparative financial statements. So if the current year numbers and previous year numbers are presented in different pages as separate set of financial statements, then that is called as comparative financial statements. See, all AFRF, all laws and regulations asks you to present it in a columnar format adjacent, corresponding to it. Ideally, we don't have much of prior year numbers presented separately, but again, they are given in the standard, so you need to know the information. Right. So over here, what are they telling? Do you need to perform any procedures for the prior year numbers? Yes, definitely, because you're going to sign a financial statement and an audit report, and that financial statements have the comparative numbers. With respect to that, what you need to check? So for all of the prior year numbers which is being presented, see whether it matches with the previous year financial statements. Let's say in previous year financial statements, the number is 10. Current year, as part of comparative numbers, that should also be 10. So check whether the comparative information agrees to the previous year financial statements. See whether whatever presentation is being made, it is as per AFRF, and whatever are the accounting policies for current year as well as previous year, it needs to be consistent, and you need to obtain written representation for whatever amount is being presented in the financial statements. Now, for corresponding figures, they are telling certain audit procedures you need to perform. Let's slowly see what audit procedures we need to perform. First one, if the audit report for prior period was modified and the matter which gave rise to the modification in current year also, it still remains unresolved. So ideally in your audit report, no, you're supposed to talk only about current year numbers. You're not even supposed to bring about previous year numbers. But in the following circumstances, you can bring in information relating to previous year. So what are they saying? Previous year, a modified opinion was given because of an issue. In current year also, the issue continues. The issue continues. In that scenario, you're expressing a modified opinion. Why are you expressing a modified opinion? In your opinion paragraph, in your basis of opinion paragraph, you need to say that you're modifying the opinion because of an issue identified in previous year and it is not an issue identified in the current year. Second, if you have obtained audit evidence that a material misstatement exists in the previous year number, and previous year they didn't even identify it, unmodified opinion they gave, and because of the misstatement in last year it is affecting your current year number, that case also you can express a modified opinion. But you can say that you're expressing a modified opinion because of a misstatement which exists in the previous year number and not in the current year number. And specifically, if prior period financial statements was not audited, you have to perform audit procedures as per SA 510, initial audit engagements. Or if it was audited by another auditor in other matter paragraphs, you need to say clearly. I told you other matter paragraphs means what? You need to give certain details which helps the users to understand three things: audit, auditor's responsibility, and audit report. So here what they are trying to tell, if the last year FS was being audited by some other auditor, in emphasis of matter paragraph, you're going to say that, boss, see, the prior year numbers was audited by some other auditor. This was the opinion and this was the date of the report. So if anything, any issue you identify with prior year, I am not the person to catch. The auditor's responsibility is with respect to predecessor auditor. So you're trying to give more information about the auditor's responsibility. What are you trying to say? My responsibility is with respect to only current year numbers and not the previous year numbers. Similarly, with respect to comparative financial statements also, they're trying to bring in the same things, right? Where if it was not audited, you have to perform procedures as per SA 510. If it is an initial audit engagement, or let's say predecessor auditor was there, you need to bring in the details of predecessor auditor as per SA in other matter paragraph, right? Now moving on to the concept of branch audit. Branch is nothing but an extension of an existing establishment, right? So each company might have different branches to show its geographical presence, to have different stores, right? So they prepare something called as branch returns, and these branch returns need to be audited by a person called as branch auditor. This is given in 143 subsection 8. Why should we audit? Because the Companies Act asks us to audit. So who can be the auditor of this branch? So there are two things over here. If the branch is located in India or if the branch is located outside India. If the branch is located in India, there are two circumstances. Whoever is auditing the company's financial statements, they themselves can audit the branch returns. But let's say the company auditor doesn't have the time. Then you can appoint another auditor as per section 139 of the Companies Act and ask them specifically to audit the branch returns. However, if the branch is located outside India, you have three options. Whomever is auditing the company's financial statements, they can go to that country where the branch is located and audit it. But if you don't have time for all of that travel and all, in that specific country, as per their local regulations, you appoint an auditor or any other person. You don't have any other you don't have a local auditor or you yourself can't go, then any other person who can audit it, right? Okay, and this branch returns needs to be audited by the branch auditor and they need to give their report to the company auditor. The next standard which we'll be discussing is SA 299. So in SA 299, what and all is being discussed? Joint audit. So it's not necessary that only one auditor must audit the financial statements. In case of very big companies, more than one auditor audits the financial statements because they want to split the risk between the people. So in case a financial statement is audited by more than one auditor, it is called as joint audit. So what are the advantages of a joint audit? Two experts are involved. So they'll be sharing their knowledge and you can consult with two people and the workload is also being shared. Since lower work is given to each of the people, there will be improved service and better quality of work and there will be a healthy competition, and with respect to cost also, individually it will be lower for each of them. What are the disadvantages? See, the biggest disadvantage is whatever fees you're getting, you'll have to share. Psychological problems, basically ego issues. One might think I am right, the other might think I am right. And there will be a lot of superiority, inferiority complex. And since two people are involved, it's as simple as too many cooks spoil the broth, right? If it is just one person, coordination will be easy. But if there are multiple people, coordination might be difficult. And sometimes they will not divide the work properly. There will be certain common areas left unattended. No one will take the responsibility. Right. Now, what are the general points which you need to be mindful of with respect to joint audit? Right. So, with respect to overall audit strategy and audit plan, all of the joint auditors and the members will come together and develop an overall audit strategy and establish an overall audit strategy and develop a detailed audit plan. And prior to even anything, they shall discuss the following. So the catchword for this is DRCPR. CRCPR we saw in factors to be considered for overall audit strategy. Here it is DRCPR. Before even starting everything, you need to decide how the work for common areas and how basically D stands for division of work. Then R stands for reporting objectives. Then C stands for consideration of factors which is going to affect the engagement team. Results of preliminary engagement activities, nature, timing and extent of resources. So basically everything is the same except their characteristics of the engagement. Here is division of work. All this you need to consider before you draft your overall audit strategy. Then all of these people will come together and discuss what are the procedures which you are going to perform. And the engagement letter shall be signed by all of the joint auditors and the management. And the work will be divided among them and there will be a document called as work allocation document and it will be signed by the joint auditor. This work allocation document is very, very important because that is the document which tells which auditor is responsible for what work, right? And the joint auditors are responsible for the work which is being assigned to them. But the joint auditors are jointly responsible in the following circumstances. See, if a work is not divided, both of them, or let's say whoever the joint auditors, they are responsible. And let's say there is a decision taken for common audit areas, let's say framework or the AFRF followed, all that are common audit areas. Matters which is brought to the notice of all of the joint auditors and all of them agreed. See, at that point you agreed. All of them agreed. Now you are jointly responsible. Whether the FS is complying with your AFRF relevant laws and regulations. And audit report being as per standards on auditing. These areas you are both responsible, but if work is allocated separately to each of you, in that case you are independently responsible. Now, here the next point. In case you, let's say one joint auditor is taking care of balance sheet, the other auditor is taking care of P&L. Let's say you're auditing P&L and you identify an issue with respect to balance sheet. So it is your responsibility to inform the other joint auditor. Even though it is not your work, but if you identify any issues, you have to communicate to other joint auditor. And how many audit reports? Actually, there will be only one audit report. There will be a common audit report. However, if there is disagreement between the auditors, one guy is telling unmodified opinion, whereas the other guy is saying modified opinion, in that case, no majority wins, nothing like that. Each auditor will express a separate opinion in their separate audit report. But the important catch over here is in their audit reports. So for one financial statement, there will be two audit reports. Specifically in other matter paragraphs, you need to clearly explain to the, so it helps the users to understand audit, auditor's responsibility and audit report. You need to say that in other matter paragraph, boss, this is a joint audit. There is a disagreement between me and the other auditor. He is expressing another opinion, but I have expressed an whatever opinion. So there is also another audit report. You decide which to rely on. So basically that you will try to say it in a polished manner. And the other guy will also tell, this guy has issued another audit report. But ideally this doesn't happen. They have to arrive at a conclusion and issue only one audit report, because the management will not let you. See, they're paying you money. They cannot make the shareholders confused because of two audit reports, right? Fine. Here, the next standard which we are going to discuss is SA 600, which means this talks about using the work of another auditor. So this usually applies for audit of consolidated financial statements, because the consolidated financial statements includes numbers of different subsidiaries, associates, joint ventures, etc. Right? So the entire financial statements is called as consolidated financial statements. The ultimate auditor who's going to sign is called as the principal auditor. It includes information of subsidiary, associate and joint ventures, right? Each of the subsidiary, associate and joint venture are called as component. And the financial statements of these components are called as component financial information. So a principal auditor is auditing the consolidated financials. But can he see all the numbers? No, the numbers are coming from subsidiaries. So what they will do is he'll use the help of another auditor. The other auditor name is called as component auditor. Sorry, it's called as other auditor. They are going to audit the component financial information. So you'll have other auditors who will be auditing the component financial information. They'll give their opinion or their conclusion. See, individually in general audit, you'll have conclusion at an account level. But over here, you're going to have conclusion at a subsidiary and associate level. So these other auditors, I want you to visualize. You have the parent company. The principal auditor is going to audit the consolidated financials. But that comprises of information from different subsidiaries and associates. Each subsidiary and associate have their financial statements or financial information. That is going to be audited by another person called as other auditor. They will have their independent conclusion, give it to the principal auditor, and the principal auditor ultimately will prepare the audit report and sign the audit report. And here in other matter paragraphs, he will clearly say that it's not just me who did the audit. I had other people also who've done the audit. The responsibility is split amongst all of us. So basically, you're trying to say that if some issue happens, don't catch me, catch them as well. This will be mentioned in other matter paragraph. So here, in this is a very small standard. What they're trying to say is you have to, give you as the principal auditor, you have to give clear set of instructions to, the other auditors, the timeline, what procedures they need to perform, what evidence they need to obtain. You need to on a timely basis, you need to have a catch up with them. Any important issues noted, you have to discuss. I mean, if you as another auditor noted any discussions or issues, you'll have to discuss it with the principal auditor. Right? And all of your findings, you need to communicate it to the principal auditor, a very small standard. Now, we are going to discuss few reporting requirements as per the Companies Act. So, you have CARO, inquiry procedures, etc., etc. First one, you need to perform certain inquiry procedures as part of Companies Act, which is mentioned as part of 143 subsection 1. The catchword is STAT PC. S stands for whether any shares or securities, whether any investment in shares or securities has been sold at a price lower than the purchase price. Basically, it's an investment for a company, it's an asset. Usually, if you make an investment, it should be sold at a price higher than the purchase price because the purpose is to get profit. But here, this is something fishy. If it is sold at a price lower than the purchase price, it indicates a distress sale. Then transactions which are mere book entries and are prejudicial, which means which affects the interest of shareholders. Basically, fraud or fictitious transactions. You need to ask them if they're existing. Whether the loans and advances given by the company are secured or not. Basically, assets. Whatever loan has been given by the company, whether it is secured or not. The next one, whether loans and advances are presented as deposits. See, loans also asset, deposits made with the bank is also asset. But a loan or advance, let's say it's unsecured, you know what these people will do? They present it as deposit. So that they'll think, okay, it's a fixed deposit. So I need not check whether it is secured or unsecured. The next one, any personal transactions, whether they are accounted in the books of accounts. Personal transactions are not allowed to be recorded in the books of accounts. Then if you have issued any shares, equity shares, and for that you are going to receive the consideration in the form of cash, whether the cash has been properly received or not. With these points, you need to perform inquiry procedures. 143 subsection 2 tells that the auditor shall present an audit report. Okay. Next one is 143 subsection 3. Over here, reporting on other matters. So here you'll have to clearly and explicitly say that whether you have obtained all of the information. So all of these points needs to be presented in your audit report. It needs to clearly be brought out in the audit report. Whether you have sought and obtained all of the information which you need for your audit, whether the books of accounts, whatever is being maintained, including the branch returns, whether it is proper or not, whether you have received the branch audit report, whether whatever is there in the books of accounts, basically ledger, trial balance, that is what is being presented in the financial statements, whether it is in compliance with the relevant accounting standards. Are there any comments which has an adverse effect on the functioning of the company? Are there any directors which are disqualified, or any other qualifications or adverse remarks which you want to make about the accounts? Whether the company has to follow and implement internal controls or any other matters as may be prescribed. All this, if you have anything to report on, you need to report it in other reporting responsibilities as part of audit report. The internal controls are generally not applicable for a one-person company or a small company. And if the turnover of a company is less than 50 crores and borrowings from financial institutions, banks and body corporate at any point of time is less than 50 crores, if both of these conditions are satisfied, in that case, internal controls are not applicable. The next thing is 143 subsection 12, which talks about reporting on fraud. See, fraud reporting has two aspects. If the amount involved as part of the fraud is less than 1 crore, or if it is more than 1 crore. See, if it is less than 1 crore, the process is, if you come to know within 2 days of knowledge, you need to report that to the board of director and tell that, boss, this was the fraud. What is the nature and description of the fraud? What are the parties involved and what is the amount? Then the board of directors needs to report all of this in the board's report. Right? You cannot force them. All you have to do is just inform them if the fraud amount is less than 1 crore. But if it is 1 crore or more, within 2 days, you need to inform the board of directors about what this fraud happened. These are the parties and this is the estimate amount of fraud involved. Then you will give them some time. You will give them 45 days time to prepare a response. And then you need to file a form called as ADT4 with the central government. So once you receive the response from the board, or even if you don't receive a response at the end of 45 days, within 50 days of receipt of response, you need to submit ADT4 to the central government. So if a fraud happens more than 1 crore, you need to report it to the central government along in ADT4. You need to say, I am the auditor, I got this details, and I have attached the board's response. But what if board doesn't give any response? No problem. Even in that case, you'll submit ADT4 and you'll say that the board has not received any response. So 2 days, report it to board of directors, give them 45 days time. Within 50 days from receipt or not receiving, at the end of 45 days, you need to submit ADT4 to the central government. Additionally, you need to report this as part of your CARO clause number 11. Now, moving on to CARO 2020. So, CARO 2020, first let's discuss. So, there are 21 clauses. This is discussed as part of 143 subsection 11. So, there are around 21 clauses. Let's quickly go through the applicability first. So, it applies to all companies except banking company, insurance company, Section 8 company, one-person company, small company. See, banking, insurance, already they have a lot of regulatory requirements. So Companies Act is telling it's okay, fine, chill. You don't have to do CARO reporting. And in case of Section 8 company, they're there for, social welfare, education and all of that. So you're doing good deeds. So no additional reporting requirement. One-person company and small company are small companies, so no reporting requirements. And for private limited companies, there are certain conditions, and all of these conditions needs to be satisfied. Only then CARO is not applicable. It should not be a holding or subsidiary of a public company. The paid up share capital must be less than or equal to 1 crore. Or total borrowings from bank or financial institution at any point of time must be less than or equal to 1 crore. And the total revenue also must be less than or equal to 10 crores. This only if all of the conditions are satisfied, then CARO is not applicable. Simple ratio, you can remember it as 1:1:10. Paid up share capital, reserves and surplus less than or equal to 1 crore. Total borrowings at any point of time less than or equal to 1 crore. Total revenue less than or equal to 10 crores. Right. The first clause talks about PPA and intangibles. You need to check and evaluate whether proper records of PPA and intangibles are maintained, and whether the management performs physical verification for PPA at reasonable intervals, and see whether the title deeds of both PPA as well as intangibles are in the name of the company, whether these PPA and intangibles are revalued, and if the change is more than 10%, then you'll have to disclose it over here, and whether any proceedings has been initiated under the Benami Transaction Act. So that is on PPA and intangibles. The second one is with respect to inventory. So AS2 clause 2. So remember it like that. Whether proper records are maintained for inventory. Same point. Proper records, physical verification. Same proper records, physical verification. Any differences or discrepancies are identified, whether it has been appropriately dealt with. Right? Whether the company has obtained any working capital demand loans more than 5 crores. See guys, understand one thing. Working capital demand loans means short-term loans, current liability. For that, so it's basically business loans to meet your working capital requirements. So here, the security which is going to be is nothing but stock. So based on your stock value only, they are going to give the loan. So initially, you want more loan, so you'll disclose more stock value. But what banks will do is they're smart. On a quarterly basis or sometimes on a monthly basis, they'll ask you to provide returns. So you'll have to declare the value of stock. So if the company has obtained a working capital demand loan of more than 5 crores, you have to check the quarterly returns filed by the company and see whether it is proper or not. Are they, making a fool of the bank, right? They are trying to, hide things from the bank. You need to verify the stock returns. Next one, third and fourth talks about loans, investments, guarantees and securities. Whether the company has provided any loans, investments, guarantees and securities to subsidiary, associate, joint venture or any other companies, and whether the terms are prejudicial to the investors. Prejudicial means whether it is going to affect the interest of the shareholders, and whether the repayment, so it's an asset to you, whether repayment of the loan whatever you have given and the interest, whether it is regular or not. In case it is overdue for more than 90 days, in that scenario, you need to check if the management has taken reasonable steps to recover the same. The next one, whether any loan or advance is due in the next year. But, so basically you have to receive the amount, but what you have renewed it. Basically you have extended the term or you have given a fresh loan, right? In that scenario, this is a risk area, you need to report it over here. And whether any loan has been granted and the terms is repayable on demand, which affects your classification, or there are no terms of repayment at all. And whatever loans, investments, guarantees, and securities, it must be in accordance with section 185 and 186 of the Companies Act. 1, PPE and intangibles. 2, inventory. 3 and 4, loans, investments, guarantees, and securities made by the company or provided by the company. 5th one, public deposits. How will you remember 5 as public deposits? Chapter 5 of Companies Act is public deposits. Clause 5 is also public deposits. So if the company has obtained any deposits from the public, then you need to evaluate whether they have followed the rules given as per Companies Act. Very simple. The next one is cost records. 6th, cost records maintenance is given as per section 148. So if cost records they have to maintain, you just need to check whether it is applicable. If yes, have they maintained? 7th one talks about statutory dues. Statutory dues means the taxes and the money which needs to be deposited with regulatory authority. Basically, direct and indirect taxes, TDS, GST, TDS, TCS, GST and all that. So, disputed and undisputed. Undisputed means you yourself know that you have to pay to the government, and without any fight, you are paying it to the government. If it is disputed, which means that these regulatory authorities, they send notice and you're saying that no, you do not agree, you're disputing it and fighting it against the court. So in case of undisputed statutory dues, you need to see whether they are regular in paying to the government. But if they are irregular and it has been outstanding for more than 6 months, disclose it as part of clause number 7. And in case of undisputed statutory dues, you need to mention the amount involved, the forum in which the dispute is pending, basically the court in which such dispute is pending. Clause number 8 talks about undisclosed income. So whether the company has surrendered, voluntarily gone and told to the Income Tax Act that this is my undisclosed income, now I am disclosing it to you, which ideally doesn't happen. Clause number 9 talks about borrowings, whether the company has defaulted in repayment of any part of your borrowings, or whether the bank, they themselves have declared you as a willful defaulter. Willful defaulter means you're defaulting wantedly. And whatever purpose for which you have obtained the loan, have you used that amount for that specific purpose, or whether you have obtained a short-term loan and used it for a long-term purpose. In that case, your funds are locked in a long-term asset and it takes a long time to generate money and you'll not be able to settle that loan within 1 year. Next, whether the company has taken loan not for yourself, you have taken the loan to meet the obligation of subsidiary, associate and joint venture. The last one is you have taken the loan but you've used the assets of subsidiary, associate and joint venture. 10th clause talks about funds raised. Have you made any IPO or FPO? In that case, are they utilized for the purpose for which it was raised? And then whether any preferential allotment or private placement was made. If yes, it must be as per Companies Act. 11th one, fraud. Whether any fraud has been noticed or reported by the auditor. If yes, the nature and amount, which means amount less than 1 crore. The next one, any fraud which is reported to the central government, which means 1 crore or more. Whether any whistleblower complaints has been made, right? Whistleblower complaints means nothing but complaints made by the employees directly to the CEO or CFO, to the head, right? That is what is called as whistleblower complaints. Next one is Nidhi company. See, Nidhi company is in the form of a cooperative society. It's a closed community with members. They will pool in their money and they will make it as equity, or they will deposit their money and get interest from the company, and let's say they don't want to go outside and get a loan from a bank, so they'll take money or they'll borrow money from the company at a lower rate of interest. So in case of Nidhi company, so they have certain rules. So the net owned funds is to deposits must be in the ratio 1:20. An unencumbered deposit must be at least 10%. When I say unencumbered deposits, whatever money has been deposited in the Nidhi company, all of those deposits should not be given as collateral. There must be certain free deposits lying as not given or not pledged to the bank, and whether there has been default in repayment of interest and principal. Then the 13th related party transactions. So for related party transactions, you need to obtain certain approvals from shareholders or board of directors, which is actually given in 188 of the Companies Act. So you have to comply with 177 and 188 of the Companies Act. And internal audit, whether internal audit is applicable to the company. If yes, have you gone through the internal audit report? 15th one talks about non-cash transactions with the director. So actually Companies Act tells that you're not supposed to have any non-cash transactions with the director. But if you've had any non-cash transaction, then the auditor is going to report it as part of clause number 15. Then clause number 16 actually talks about non-banking financial companies and core investment companies. So whether if it is an NBFC or a core investment company, they have to obtain certificate of registration from RBI as per RBI Act. But certain core investment companies are exempt because of certain conditions. So if they are exempt, they don't have certification of registration. So you have to see whether they are actually meeting the exemption criteria or not. The next one is cash losses. What are the cash losses which has been incurred in the current year as well as the previous year? You'll have to bring in both the information. When they say cash losses, it means nothing but, let's say in your cash flow statement, your cash flow from operating activities, let's say it's negative, it means that it is a cash loss. And 18, in case any statutory auditor has resigned during the year, that also you'll have to bring in over here. 19.1 material uncertainty. It again talks about going concern. If you've identified based on the financial ratios or any other factor, if you feel that the material uncertainty exists, in audit report separately there will be a paragraph, and also in CARO clause number 19 you need to report it. Clause number 20, it talks about CSR section 135. So in respect of any ongoing projects, whether the money has been transferred to the special account within, whether the unspent amount has been, transferred to a special account, and whether the CSR expenses are in accordance with your Companies Act requirement under section 135. Clause number 21 talks about CARO reporting for consolidated financial statements. Over here, in case it is a standalone financial statements, it means you'll have to report only from clause 1 to 20. However, if it is a consolidated financial statements, you need not bring clause 1 to 20, because consolidated financial statements mean what? Information from standalone. Already 1 to 20 you would have reported in standalone, no? So in consolidated also you need to audit it. There will be a separate audit report. So from clause 1 to 20, don't bring anything. Refer the respective audit reports. Here, only if there are any negative remarks or negative comments from clause 1 to 20, those negative remarks or qualification, you need to bring it as part of clause 21. So clause 21 applies to only consolidated financial statements. Clause 1 to 20 applies to standalone financial statements. Clause 21 applies to consolidated financial statements. So in clause 21, in case of a consolidated financial statement, you'll bring in a summary of all of the negative qualifications or remarks made in the audit report included as part of CARO of the standalone financial statements. Clause 1, PPE intangibles. Clause 2, inventory. Clause 3 and 4, loans, investments, guarantees and securities. Clause 5, public deposits. Clause 6, cost records. Clause 7, statutory dues, whether disputed or undisputed. Clause 8, undisclosed income. Clause 9, borrowings. Clause 10, funds raised in the form of IPO, FPO, private placement or preferential allotment. Clause number 11, fraud. 12, Nidhi company. 13, related party transactions. 14, 14, internal audit. 15, non-cash transaction with director. 16, NBFC core investment company. 17, cash losses in current year as well as previous year. 18, resignation of statutory auditor. 19, any material uncertainty relating to going concern. 20, corporate social responsibility in accordance with 135, and 21, CARO reporting for consolidated financial statements. 1 to 20 applies for standalone financial statements, and 21 applies for only consolidated financial statements. So these are the topics discussed as part of chapter. Right. Now we'll be moving on to your 11th chapter, which is ethics and terms of engagement. So here we have the standards SA 210, SA 220 and SQC 1. Again, this chapter also there are around 2 questions which is being asked. So it can be either for 9 or 10 marks. So all of these 3 chapters put together are close to around 25 to 27 marks, right? Okay. So over here, first the chapter talks about professional ethics or ethics in general. Ethics in general, it means nothing but moral principles. We as individuals, we should have morals, and we are grown up with a lot of moral principles, right? Similarly, if you're going to be a professional, a lot of people are going to rely on your work. So it is very, very important for you to be ethical. So that is what is called as professional ethics. Like, let's say for a doctor, they have their own code of conduct. For lawyers, they have their own code of conduct. Similarly, we as chartered accountants, we have our own ethics and code of conduct, which is what we are going to discuss now. So professional ethics as such means the moral rules and principles which is going to guide a professional's behavior is called as professional ethics. Okay, fine. There are certain rules and principles which I need to follow. What are those rules? So there are certain fundamental rules which you need to follow. What are those fundamental rules and principles which you need to follow? The catchword for that is IPOPC. So first rule or principle which I need to follow is I. I stands for integrity. Integrity means being honest, right? At all times you need to be honest. And then P stands for your professional competence and due care. See, at all times you need to keep yourself upgraded with all of the technical knowledge which is happening, whatever amendments are being happening, because you are expected to know more than the management. And whatever work you need to do, you need to take due care while performing that work. And then O stands for objectivity. At any point of time you should have your own judgment, and you should not let yourself to compromise your judgment, and you should not be influenced by others. That is what O actually means, which means objectivity. The other P stands for professional behavior. So professional behavior is behaving in such a way that you should not bring discredit to the profession. When I say discredit, it means nothing but a bad name. You should not bring a bad name to your profession. In that way you are expected to behave. That is what is called as professional behavior. And confidentiality means not sharing any information which you obtain during the course of your audit. Any information you obtain, you'll have to maintain utmost secrecy and not share it with anyone other than the engagement team, because they trust you and they give all of the information. So you are not expected to share it with any of them. So these are the fundamental rules which they expect you to follow as a chartered accountant. So the catchword again is IPOPC: integrity, professional competence and due care, objectivity, professional behavior, and your confidentiality. These are the fundamental rules. So that is a little bit on professional ethics. After that, we had your independence on auditor. So independence on auditor means you standing by yourself and not being a subordinate to anyone, and your decision should not be based on other person's wishes or direction. So you are able to stand independently alone and take all of the decisions without being a subordinate to other people. That is what is called as independence. It is a condition of mind and personal character. And there are 2 perspectives. One, let's say I'm an auditor. How I see myself. Do I feel that I'm independent? That is called as independence of mind. And how the stakeholders see me. Do they also see me as independent from the company? So there are 2 perspectives. Both should agree. Only then you are considered as an independent auditor. How I perceive myself is called as independence of mind. How the stakeholders perceive me or my independence is called as independence in appearance. And when I say independence, it means I should not be related to the company or entity which I'm going to audit in any ways. And at points there will be certain threats to your independence. So the threats to your independence means scenarios or circumstances which affects your independence or where you lose your independence. So the catchword over here is RUFI S, right? RUFI S. R stands for self-review threat. So where you have prepared something and you reviewing your own work is called as a self-review threat. So there can be circumstances where you would have prepared something and you are the one auditing that. A stands for advocacy threat, where you are trying to promote your client's business or interest. Let's say there is let's say you're working for Britannia, or you're the auditor of Britannia and you love their biscuits. You cannot go ahead and advocate, right? Because if you go and advocate the client's product or business, it means that you become their unpaid marketing or salesperson. Then it means that you're an officer or employee of the company. Then you're not independent, so you're not supposed to promote the client's business. If that happens, then you have an independence issue. F stands for familiarity threats. When I say familiarity threats, it means getting too familiar or sympathetic with the client. So whenever you have a very long relationship, or you talk with someone every day, you slowly start becoming friends, and it becomes difficult for you to, be independent or establish your points clearly. Similarly, like let's say you're the auditor of a client for 10 years and you identify a misstatement, but you're very, very close to the CFO. It becomes a very difficult conversation. And you'll be like, even if you go and tell the client will be like, come on, we both of us know each other for so long. This is just one of this happened once in 10 years. It has not happened till now. So can you just ignore? If that happens, then your independence is affected. You're becoming a subordinate to others' wishes. So you will not remain independent. I stands for intimidation threat, where, they're affecting, or they're not making you act or think clearly or objectively, where they're trying to threaten you or intimidate you. In that scenario, you lose your independence and you act emotionally. S is self-interest threat, where you have a financial interest in the client. So all of these scenarios will result in affecting our independence. If that is the case, if that happens, your standards or your institute material tells that you have to place certain safeguards to these independence. Try to place these safeguards when the threats exist. But if you're unable to implement these safeguards, then you should not accept the engagement. Or if you've already accepted, you need to come out of the engagement, which is called as withdrawing from the engagement. Right? Okay. Moving on to the next topic which is being discussed, which is professional skepticism. This is a very, very important quality of any auditor. Being skeptical means always asking a lot of questions. So over here, professional skepticism means three things. The definition covers three things: having an attitude of questioning mind, being very, very alert to conditions which indicate possible misstatements which can be due to fraud or error, and critically assessing the audit evidence. Questioning mind, being alert to conditions which indicate possible misstatements which can be due to fraud or error, and critically assessing the audit evidence. Right? Why should you remain alert? Why should you be skeptical? Why should you critically assess the audit evidence? Why? Because it reduces the risk of the following. You will overlook, like for example, in financial management or advance accounts or costing, you just look and go and write, and the same question would have been asked. But some people, sometimes they'll not be able to start. It's like it's very familiar, but they're not able to start, because you will have a starting problem because you overlooked it. Actually, you're supposed to solve it, right? Similarly, over here also, you need to critically look at each and everything. You cannot just overlook, or just say, okay, fine, I know this already, and just move off. So it reduces the risk of overlooking. You will not arrive at any inappropriate conclusions or assumptions, and you cannot overgeneralize while drawing conclusions. So they're asking you to ask a lot of questions, check everything in detail, and remain alert, so that you don't overlook unusual circumstances, you don't draw inappropriate assumptions or conclusions as part of your audit. And when they say remain alert to, it means remain alert to contradictory audit evidence. Let's say you obtain some information. Now, whatever information which you're obtaining is contradicting, is different from what you obtained earlier. And any questions on the reliability. Reliability means the trust which you can place on certain audit evidence. And let's say there is something which is indicating fraud, or where whatever procedures you have performed, it's not enough, you'll have to perform more audit procedures. All these are kind of risky area, so you'll have to be very, very alert in these circumstances. So that is on professional skepticism. Right. Now moving on to the first standard, which talks about your engagement letter. So SA 210, it means nothing but agreeing the terms of audit engagement. So here, first it talks about So we discussed, right, in preliminary engagement activities, you will do client acceptance and client continuous procedures, then you will evaluate compliance with ethical requirements. Then after that, you'll go ahead and draft an engagement letter. So how are you going to draft? Who is going to draft? What is going to be there in an engagement letter? All this is discussed as part of SA 210. So in SA 210, before even drafting the engagement letter, there are certain preconditions which you need to check. So there are two preconditions. Check whether the AFRF is acceptable or not. When I say AFRF, it means applicable financial reporting framework. What does applicable financial reporting framework as such mean? It means nothing but the laws and regulations and different standards which is followed for preparing the financial statements. You have to understand whatever they have followed is correct or not. And the management should acknowledge its responsibility for three things: preparation, presentation of financial statements, implementation and operation of internal controls, and providing unrestricted access to information, additional information, and employees of the organization. Only if these two are present, then only I'm going to go ahead and draft an engagement letter. See, even before getting into a very big commitment, you orally talk and discuss certain conditions. That is what is called as preconditions over here. Two things: check whether whatever laws and regulations which they have followed for FS preparation is correct, and there are certain important management responsibilities. You have to tell them and say that I am an auditor. I believe that this is your responsibility and it's not my work. So if you agree to both of these conditions, then I can go ahead and draft an engagement letter. But however, if any of these management or those charged with governance are going to, pose a limitation on your work, in that case, if they're going to, impose certain problems or say, no, I will not give you, I will create problems and all of that, you can go ahead and not accept the engagement. And you need not even go ahead and draft the engagement letter. Now, the contents of the engagement letter is what we are going to discuss now. So the standard SA 210 tells that mandatorily you need to include all of these 5 points. First one, the objective and scope of your audit. What is your objective and what is the scope? What are the management responsibility? What are the auditor's responsibility? Let us split because it's an agreement. And the AFRF which is being used, and the expected form and content of audit report. So basically you're giving a sample of your final output because they're going to pay a lot of money to you. And you'll have to show them how your audit report is going to look like. So you'll have to give them a sample, which is nothing but how your audit report is going to look. So an expected form and content of your audit report. So these are the 5 points. What is the work which you're going to do? What are your responsibilities? What is the management's responsibility? What AFRF have they followed? See, preconditions, both of this, management responsibilities and AFRF, is already discussed orally. But you never trust oral confirmation. You'll have to get it in writing and sign it as part of the engagement letter. Moving on to the next topic, in case of a recurring engagement, what will happen? So in case of a recurring engagement means it's not a new client. Last year you have did this audit, right? It's not a new engagement or a new project for you. So every year should I draft a new engagement is the question. Actually, if it's a continuing client or a continuing engagement, you need not draft an engagement letter every year. You need not. Only in the following, you can continue with the same engagement letter. However, only in the following circumstances, you need to execute a new engagement letter. So the catchword for this is M, R, and C. C, there are 6 points. So M stands for where the management misunderstands the objective and scope. Whereas, so here what they're trying to tell is management didn't understand what is the service which you are actually providing, or any revision of special terms and conditions. Let's say the fee revises, audit fee. In that case, you have to execute a new engagement letter. So revision of terms and conditions. Then C, changes in the senior management, ownership, or nature and size of the business. Any changes in the business which happens, then sign a new engagement letter. Changes with respect to management, ownership, senior management, ownership, and nature and size of business. Then regulatory requirement, reporting requirements, and AFRF. And if any of these changes happens at a macro level, in that scenario also you'll have to execute a new engagement letter. In case preconditions does not exist, as I told you earlier, you will not accept the engagement. Okay. in case management asks you to change certain terms and conditions and it is not reasonable, in that scenario you can withdraw from the engagement, right? In case, so there is another scenario where the management requests for a lower level of assurance. When I say lower level of assurance, it means from reasonable assurance to, let's say, limited assurance, right? Limited assurance engagement. If that is the scenario, what will you do? First, before even agreeing to the change, you'll have to discuss with the management and see if there are any legal or contractual implications because of this change, and understand why they actually want this change. And whatever work you have performed, you have to just completely ignore it, and you'll have to, the whatever engagement letter signed earlier will be considered as null and void, and you'll have to draft a new engagement letter. And in the new engagement letter and new report, you shall not make any reference to the old work performed or the old engagement letter. But however, if you don't want to change the terms, if you don't want to accept a new level of assurance, you can withdraw from the engagement. So this is what is there broadly with respect to SA 210. Now moving on to the quality control standards, which is SQC1 and SA 220. So before even moving on to SQC1 and SA 220, you need to know at a broad level what is the difference between SA 220 and SQC1, right? So SQC1 we discussed in the first chapter, right? SQC1 applies to all types of assurance engagement, whereas SA220 applies to only audit of financial statements. When I say SQC1, it is implemented at a firm level, at an audit firm level. It applies to the entire firm. Whereas when I say SA220, the quality control, it applies to only that specific audit project. There will be a lot of other projects, but SA220 applies to that project only, but your SQC applies to the entire firm as a whole. So basically, this SQC1 and SA220 tells you what rules and regulations which you need to implement so that you provide high quality work. That is the main purpose of, SA220 and SQC1. Now, what are the elements which is being covered as part of SA220 and SQC1? Actually, we're going to quickly cover it as part of just one small table, right? This is what in brief is there as part of your SQC1 and SA220. So the catchword for that actually is LEHEM in case of SQC1, and in case of SA220 it is LETEM. So see, the ideology behind both the standards are same. It's just that one small change is there, or one small difference is there between these two. When I say L, it means that ultimate leadership responsibility. Who is responsible? So in case of SQC1, it is the managing partners of the firm who is responsible for implementing quality controls. Whereas in case of SA220, it is the engagement partner's responsibility to implement quality controls. Again, quality control means what? Rules and regulations which ensures that we deliver high quality work. So ultimate leadership, it's managing partner in SQC1 and it is engagement partner in SA220. When I say managing partners, it's the partner for the firm as a whole, an audit firm as a whole. When I say engagement partner, it means the engagement partner for that specific audit project. Then E stands for relevant ethical requirements. Now only we discuss professional ethics. So they have to establish rules and principles which ensures that we all follow the code of ethics which is being introduced by or issued by the ICAI. We need to comply with all of the ethical requirements. We need to remain independent. We need to give annual confirmations regarding our independence. All these are examples of quality controls which they implement at a firm level. So this needs to be followed at a firm level as well as an individual project level. With respect to firm level, all the resources need to follow. When I say project level, it is just the engagement team members who need to ensure that they follow the code of ethics. So basically, SA220 is a subset of SQC1. So leadership, E stands for ethical requirements. You need to ensure that there are rules to ensure that we follow our own ethics. Only if we follow ethics, the quality of work will be good. Then A, A stands for client acceptance and client continuance. We already discussed this client acceptance and client continuance before even accepting a client, or even if it's a recurring client, you need to perform certain background procedures or background verification procedures to evaluate what is the nature of business they are doing, the integrity of the shareholders, owners, directors. Then only you should go and accept the engagement. And here the additional point is, in case you find out that something is wrong or something is fishy, you need to be a responsible person and see if this needs to be reported to any regulatory authority. Let's say they're involved in money laundering. You have the Prevention of Money Laundering Act, and you'll have to report it to that respective authority. Right, here is where the difference is coming. H stands for human resources and T stands for engagement team. H is for SQC1 and T is for your SA220. As I told you, SQC1 applies to the firm as a whole. So, the entire human resource. But whereas SA220 applies to only that specific project. So, it applies to only the engagement team. So, over here, whether it is human resources or engagement team, they're talking about the policies which is introduced for hiring this human resource or hiring the engagement team. And what policies do we have to upgrade their technical skills and knowledge? So any firm you take, they'll have to implement certain trainings, or even when they're hiring or when they're hired, you have onboarding sessions and all that. All this, why are they having? Because so that you are equipped with all of the knowledge. You know what's happening around. See, if it is not mandatory, trust me, none of us will go research and do it. So that is why they're implementing all of this, so that we are of good quality, so that our work becomes of good quality. And engagement performance, I'll come to that a little bit later. Now talking about monitoring. Monitoring it talks about, okay, fine. Now the firm or at the team level, they have implemented these rules and regulations. But how will I know whether the people are following or not? For that, a firm or a team will have a monitoring committee who will see whether we are following all of these controls or not. It's similar to that of, let's say there is a rule of wearing helmet, right, while you're driving. That is called as a quality control. Why do we have to wear helmet? Because it helps in protecting the quality of our life. So that is an example of quality control. It is there. But do we all follow? Most of us don't follow, right? So for checking that or for monitoring that, we have something called as traffic police. So that is an example of monitoring aspect. So even though they establish these controls, they should have something called as a monitoring committee to overview and to check whether all of us are complying with or following with these controls or not. When I say engagement performance, right, as part of SQC1, right, over here, what are they trying to tell? Only if you ensure consistency, then only you can achieve quality. And so they're talking about how well or how consistent the engagement is going to perform. Next thing, they talk about two things. One is consultation and the other one is EQCR, which the full form is Engagement Quality Control Review. So over here, what they're trying to say is, when I say consultation, let's say I'm an intern or an article assistant. I don't know anything. Then I'll ask my senior. Then if he or she doesn't know, then goes to the manager, senior manager. You go to the partner. But what if the partner doesn't know? The auditor. He'll go and ask another partner in the same firm. If they also don't know, you'll have to go for consultation and ask other people. So that is what is called as consultation. In case of specialized expertise, you can go ahead for consultation. Now, when I say EQCR, which means Engagement Quality Control Review. In Engagement Quality Control Review, so when you are performing the audit, there will be another partner who will be, continuously monitoring how well the audit is going on or what is the quality of audit. So this is applicable for listed companies. So you will have an auditor, you will have an engagement team which will be performing. Simultaneously, there will be another partner who is going to review the quality of work. That mechanism is called as Engagement Quality Control Review. Right? And for SA220, as part of engagement performance, they're just telling that the engagement partner is ultimately responsible as to how well the team performs. They direct, supervise the engagement team, and they'll evaluate whether the audit report is proper. They'll review all of the audit evidence. They'll see whether it is sufficient and appropriate, and they'll take appropriate consultation in case of difficult matters, right? So this is what is given as part of chapter 11. Again, another 2 questions around 9 to 10 marks can be asked from chapter number 11. So we discussed about professional ethics, independence, professional skepticism, essay essay 210, agreeing the terms of audit engagement, essay 220, and SQC1, basically the quality control standards.